Okay, good morning everyone. Welcome to Byju's exam prep IAS. This is Shyam Kaggod here. Now before I start the discussion, if there is no issue with the sound, please give me a thumbs up so that I can start the discussion. If there is no issue, please let me know. Either a thumbs up, a Y yes, alphabet yes, or alphabet Y, anything is okay. Done. Thanks a lot. Let's start. So before we continue with the discussion, what we discussed yesterday. What did we discuss yesterday? We started with the concept of taxation. Okay, idea of a taxation. Now in taxation, what we have discussed, what is a tax? What's a tax? It's a charge or a levy that is imposed by the government. It could be imposed by the government on people, that is individuals such as you and me, can be imposed on a company, can be imposed on investors, etc., etc., etc. So whenever government will impose a charge like this, that is called as a tax. And why does government impose a tax? It imposes a tax because government wants to collect revenues. And they want to collect revenues so that they want to spend on road, social welfare, etc. That is a precise reason why government imposes taxation and collects a lot of these taxes. Then we have discussed the idea of a tax base. What is the idea of a tax base? Tax base refers to the object on which government will impose a tax and collect a tax. Simple. Right? The tax refers to, or tax base refers to the object on which government will impose the tax and collect the tax. For example, income, wealth, asset, etc. All of these are nothing but the objects on which government will impose a tax and collect the tax. Next, we have discussed types of taxation systems. Direct taxes, indirect taxes. What's a direct tax? Whenever government will impose a tax on one person, collects the tax from the same person, the burden of tax will fall on the same person. That is called as a direct tax. Indirect taxes, government will impose a tax, but the burden of taxation can be transferred. Best example, GST. Government imposes GST on hotels, restaurants, but they will not pay the tax from their pocket. When you go to a restaurant, the owner of the restaurant will collect the GST from you. The government imposes a GST on this bottle, that is the seller who is selling the bottle. But the government, when they impose it, the shopkeeper will not pay that, let's say 10 rupee or 20 rupee from their pocket. They'll simply collect it from you when you will purchase this when you will purchase this product. Okay, so that is the basic idea for direct tax and indirect tax. Then there is a concept of surcharge and assess. Surcharge is a tax or a charge that is imposed by the government in addition to, generally these are accompanied by the normal taxes. The objective here is government wants to impose more taxes in addition to existing taxes. The reason is government feels there is a more potential to collect taxes, and so government will impose and collect a surcharge. And what about cess? Cess is basically the idea or a charge or a tax that is basically imposed by the government with a certain objective to meet. They want to meet certain objective, right? For that, they are going to impose and collect the taxes, right? And whenever that objective is met, government may continue or discontinue the concept of cesses. But in addition to these, I've told you surcharge and cesses, whenever they are imposed by the government, these are not part of the divisible pool of taxes, right? From the divisible pool of taxes, the distribution is done between the center and the state, but these are not part of the divisible pool of the taxes, which means when the central government imposes such taxes, it is entirely the power of the center whether to utilize complete amount or distribute it with the states. Then we have discussed the safeguarding duty, the anti-dumping duty, and a countervailing duty. Anti-dumping, because there is a dumping activity. Dumping activity, government will impose certain taxes on these imports, right, in order to protect, in order to increase, right, the market prices. Then countervailing duty, subsidies are given by the government, that is exporting government. We want to offset it. We want to basically offset it. That is basically countervailing duty. And a safeguarding duty, imports suddenly surge, I repeat, imports suddenly increase or surge. As a result of this, domestic market would be affected. So government would be imposing taxes in order to protect domestic market, that is safeguard duty. So after that, we started with the discussion of certain types of direct taxes. We'll have a lot of discussion today on the concepts. Focus now. We started with the Income Tax Act of 1961, done. Then within the Income Tax of 1961, we were discussing corporate taxes. That is, in the corporate tax, government has allowed certain companies, it's an option, government has allowed certain companies to pay corporate tax rate at 22%. And we were discussing what are the benefits associated with that and what are the issues or concerns associated with that. The benefits are done. Let me start with the issues or concerns. First one, the tax receipts of the government will automatically come down. I repeat, the taxes collected by the government automatically will come down. It should not be very difficult. For example, tell me, will government collect more taxes at 30% or 22%? Let me know. Will the government collect more taxes at 30% or 22%? Collect more taxes, right? Arre baba. So government will collect more taxes, more taxes at 22%. No, my dear, they will collect more taxes at 30%. What is the argument? Right? When you impose 22%, you will collect more taxes compared to when you will impose 30%. How? It's a very straightforward question. So government would collect more taxes when you have 30% tax rate. But government, when it will reduce, give an option to the company that you can pay 22%, don't you think automatically the amount of taxes collected by the government will come down? Is it okay? Amount of taxes the government will be collecting will be coming down. That is basically the argument here. The amount of revenues that the government will collect will be affected. And is it true? Of course, yes. Various experts have stated that with Government of India giving an option, right? Government of India will be giving an option of 22%. The government will end up collecting more than 1 lakh crore rupee lesser. Is it okay? Government will be collecting more than 1 lakh crore rupee less amount in taxes. Second one is, we expect that with reduction in the tax rate, the investments will suddenly increase in India. Foreign companies will be more interested in India. They'll start investing in India. The argument is the investments will increase not only because of taxation. There are various factors which will have an impact on investment in the economy. For example, sir, how do you say that? Let's imagine you have 1,000 crore rupees. I hope you understand this. Let's imagine you have 1,000 crore rupees. You're a crorepati. Now you want to invest in India. You will be worried about how much taxes you will pay when you earn profit in India. But in addition to that, you'll also be worried about how easy it is to acquire land in India. If you disagree, please do let me know. How easy it is to acquire land in India. Sir, why? Why should I be worried about land acquisition? You want to set up a manufacturing facility, don't you want land for it? What is the cost of labor in India? What are government policies in India? What are the government policies? Sir, why government policies? Why are you writing it? Simple, have a look at this. Imagine Government of India will allow you to invest in India. Government will ask you to pay lower taxes. But what if government says half of the raw material you'll have to take it from domestic market itself? I'll repeat the example. Government will tell you, okay, you can invest in India. You don't have to pay 30% taxes. You can pay only 22% taxes. But what if government says, now half of the raw materials that you will purchase, you will have to purchase from India itself. You do not have any option. You will have to purchase from India itself. Now, what if the quality of raw material that is available in India is not qualitative enough? What if the cost of the raw material that is available in India, it is comparatively costlier? Means if you import the same raw material, even with import taxes, it is cheaper for you rather than purchasing from the domestic market. don't you think such kind of policies will automatically have a negative impact on the investments in India? Please do let me know. Participate and please do let me know so that I can understand that you have understood and I can go forward. So the argument is simple here. Taxes are reduced. Taxes are reduced and we expect investments to come in India. But only taxation will not attract investments. There are a lot of other issues that will help in attracting investment. And in case of India, there is problem with all the other factors. For example, take labor here. Take labor here. Take the labor. Imagine you will invest 500 crore rupees in India, set up a manufacturing facility. Would you want a skilled labor or not? Do you want a skilled labor or just any labor? Of course, you would want skilled labor. But in case of India, one of the biggest problems is availability of skilled labor. Right? The labor is available. People are willing to work. But what about availability of skilled labor? That is a problem in case of India. Why it is happening? What are the reforms taken by the government, etc., etc.? We'll have a look at it later. Please don't worry. We'll have a look at the labor issues in India. But what I'm trying to tell you here is, with the lowering of the corporate tax rate, we expect a lot of investments to come in India. But the investments will not be improving or will not be coming only because you have reduced the taxation. There are so many other factors that will have an influence over the inflow of investment. So government should take also certain measures under all these heads. Can I connect it to current affairs? Can I connect it to current affairs? All of you heard of bullet train project, right? Bullet train project. How many have heard of it? Initially, when the proposal was given by the government, we were supposed to start the bullet train project by 2023. Check it. By 2023, we were supposed to start it. How many of you have read the current affairs regarding bullet train project? 2023, we are in 2023, by the way. Right? Do you think we are going to start the bullet train project this year? Absolutely no. Very recently, the government of India has updated the Infonet. Bullet train project is going to start now in 2026, not 23, rather 2026, not in 2023. Now, if you start by basically finding out what is the issue, why there is a delay in this. One of the delay has been acquiring land. One of the delays has been acquisition of the land, acquiring land. Sir, why land is required here? My dear, you will have to lay down railway tracks. I hope you understand. We will have to lay down the railway tracks. For that, you require land. So, land acquisition has become a problem. So, again, please understand, a lot of current affairs concepts are there. You will have to keep on reading. Only then you will understand, okay, yes, only tax is not an issue here. There are other issues which are plaguing Indian economy. Government has to implement reforms in all of them. Third point, what about the other policies of the government? What if government of India imposes certain restriction on imports? What if government of India imposes higher taxes on imports, which they are doing right now? That will have a huge impact on investment scenario in the domestic market. Right? So these are some of the benefits, some of the issues or concerns related to this decision of the government. Now, before going forward, many of you are reminding me, or many of you are basically telling me, sir, you are writing 22%, it's wrong. In the book, they have given 25%. Follow this carefully. The actual rate is 22%, but in addition to 22%, there will be certain additional taxes. Is the logic okay? Right? Actual rate is 22%, but you will not just pay 22%, you will also pay surcharges, cesses, etc. like this. And that is the precise reason the effective tax rate will not be 22. It will move up from 22% go till 25.17%. Right? So that 25% that you're coming across in the books or any other source or any other material, it is because of taking into consideration these kind of surcharges and cesses. Okay. Now let me go to one more type of a tax, direct tax by the way. Capital gains tax. Capital gains tax. Now before explaining to you what is the idea of a capital gains tax, All of you understand the term asset? Anybody who has a problem with the term asset? What is the meaning of asset? Asset simply means anything that has a value in the market which will get certain returns to you. I hope you understand. Asset is anything that has market value but it will get returns to you. For example, you own building. I hope you understand. You own building, right? Is it an asset? Yes. Does it have a market value? Yes. If you sell it in the market, will it get returns to you? Yes. Can I give you one more example? Gold. Gold, right? In every one of your homes, including my home, by the way, we have gold, right? Is gold an asset? Yes. Right? Imagine you have a Mona Lisa painting. Again, you don't have it, neither do I have, but imagine you have Mona Lisa painting. Is it an asset? Yes. Does it have market value? Yes. So argument is simple. There is a asset like this. You will sell the asset in the market. You will fetch certain returns. It will get certain returns to you. It will fetch returns or profits to you. So have a look at this. This asset, whenever it is sold, and you earn returns. Returns in simple terms, nothing but profits. I'll give a simple example. Imagine you will purchase a land. You will purchase a land today and you will pay how much? Let's say 2 crore rupees for this land. You will pay 2 crore rupees, purchase the land. And after 2 years, you will sell the land not at 2 crore rupees, let's say at 3 crore rupees. You purchased at 2 crore, you sold at 3 crore. First and foremost, answer to my question, did you make profits or not? Let me know. Did you make profit or not? And I'm not taking very difficult numbers, I'm taking simple numbers. Right? I know early morning you don't like to calculate. Yes, you made certain earnings or profits. Now, rather than calling it as a profit, I'll refer to this as gains. Is it okay? Rather than calling this as profit, I'll refer to this as gains. But you are earning gains on what? You are earning gains on an asset. Assets, another term for asset is what? Capital. Do you remember this? Another term for asset is nothing but capital. Sir, where you have discussed all of this? First class. First class itself, I have discussed all of it. Another name for the capital is nothing but assets that you have acquired. So have a look at this. You are earning gains on assets, and assets are nothing but a representation of the capital. So can I call this as capital gains? I hope you understand. Can I call this as capital gains? That is, you are making gains on certain capital. Now, government says when you are earning money, when you are making gains on the capital, I will impose a tax. And that tax is referred to as capital gains tax. Now, I hope you understand why the name capital gains is used here. Right? Why capital gains is used? You have purchased an asset or you have certain assets. You will sell the asset in the market. This asset is nothing but capital. Now, when you sell the asset in the market, you make certain gains. And government will impose a tax on this. This is called as capital gains tax. Capital gains tax. Now, next point, can the capital be movable and immovable? Think of it. Just think of it. Can the capital be movable and immovable? Can I call this capital or assets as movable asset as well as immovable asset? Sir, example, land. Right? Land is immovable. You cannot move the land. Do not imagine you will bring a crane, cut the 4 pieces, right? Or let's say cut in the 4 corners, you will lift it and take it away. No, you can't do that. Right? Land is immovable. What about flat? What about house? Immovable. On the other hand, gold. Tell me, gold, is it movable? Yes. Paintings, is it movable? Yes. right? Let's say shares of a company. Now I'm using a new term, do not panic. Do not panic. We'll discuss shares in detail later. Shares of a company, yes, movable. So argument is the assets can be movable as well as immovable. Both of these will be covered under the concept of capital gains tax. Point number 2. Let me go to point number 3 here. Now, when you will purchase the asset, sell the asset, again there was a confusion. What rate of tax should be imposed? If you purchase, own it. Understand this. I'm using the term own, right? Owning period. Another term to represent owning period is also holding period. In books, they will use the term holding period. Now you will try to correct me, sir, it is not owning period, it is holding period. What is the owning period here? I'll give a very simple example. Imagine you purchased a land in 2022. You sold the land in 2024. Again, don't worry about the dates, nothing, don't worry about it. Can I say holding period or owning period is 2 years? Is it okay? Holding period or owning period is 2 years. So initially, Government of India decided, let's divide the capital gains tax into 2 types. I'll repeat it. Let's divide the capital gains tax into 2 types based on owning period or holding period. The one will be referred to as a long-term capital gains tax. Second one will be referred to as short-term capital gains tax. Initially, when we introduced the concept, government said, if you hold the asset for 3 years or more, I repeat it, if you hold the asset, if you own the asset for at least 3 years and sell the asset, I will impose a tax which is called as long-term capital gains tax, LTCGT, long-term capital gains tax. But if you own the asset for less than 3 years, that is up to 3 years, and sell the asset, I will impose short-term capital gains tax. Any difficulty, please do let me know here. Focus on the point of discussion. Don't bring unnecessary things. Focus. Right? You own asset for up to 3 years and sell it. You will make gains. Government said short-term. You own the asset for more than 3 years, sell it. Government said long-term capital gains tax. Initially, this was the concept. Now you will ask me, sir, how much is the rate? Do not focus on it. This is my suggestion to you. Do not focus on it. Why? Under the capital gains tax, we have divided the assets into different classes. I've given a very simple classification here, movable and immovable. But if you start reading in detail about it, if you start doing a PhD about it, you will realize that we have divided them into different classes of assets. And for each class of the asset, short term is different, long term is different. I repeat, short term, what is short term? It is different, long term is different. I'll give a very simple example. Now, if you purchase a share, and sell it in the market, and you purchase and sell within 12 months, you purchase a share of, let's say, Adani company today, sell it in the next 12 months, and you make gains. Government will impose a tax which is called as a short-term capital gains tax. And if you purchase the share of Adani company today and sell it after 12 months, government will impose a tax which is called as long-term capital gains tax. So understand this, initially we said 36 months. Initially we introduced the concept of 3 years. But over a period of time, for various assets, we have kept on changing it. We have kept on changing the classification, or we have kept on changing the holding period. I'll give you one more example. Land. You purchase a land, own it for up to 2 years and sell it below 2 years. Then the government says, I will impose a tax, short-term capital gains tax. You own it for a period more than 2 years and sell it in the market. I will impose a tax which is called as a long-term capital gains tax. So I hope you understand this now. Government initially had a concept of having a uniform structure of holding period. But over a period of time, based on the requirement in the market, government through amendments have kept on changing the holding period. Number of assets in the classification are many. Rates which are applicable are also different. The holding period is also different for one set to another set. Now let me ask you a very simple question based on this. Do you think this structure is easier or difficult? Let me know. Right, I'm telling you, different assets are there, asset classes are many, right? And from one asset to another asset, the time period changes. The rate which is applicable also keeps on changing, right? That is from one asset to another asset. Is the structure easier? No, it is very difficult. It is very complicated. In simple terms, it is very complicated. That's the reason we were expecting government to make changes in the capital gains tax in the recent budget. On the 1st of February, government announced a budget. Many experts were basically saying we might see government will make changes in the capital gains tax structure. We will make it much more easier. We will make it much more uniform. We will have a same holding period for all the asset, etc., etc., etc. Has it been done by the government? Absolutely no. Government of India has not made any changes. Even today, the same concept of capital gains tax structure is there in the implementation. Done? So this is basically the concept related to idea of a CGT, capital gains tax. Next is the idea of tax avoidance. Is a TV an asset? My dear, will you purchase TV to sell TV? You tell me. As a household, will you purchase TV to sell TV? And again, basic, you apply basic right understanding, no? Why do you want to complicate everything? How many of you will purchase this bottle? Now you'll ask me, sir, bottle has market price. You told market price, asset has a market price. So the bottle that you're holding has a market price. Is it an asset? Let me ask you a counter question. Will you purchase the bottle to sell the bottle? Think of it. Will you purchase a bottle to sell a bottle? No. But will you purchase a land? One of the objectives will be, right, maybe in the future the price would be very, very high. I will sell it. Right? So argument is simple. Do not complicate everything. Do not complicate everything. So on bottle, government will always impose a tax. There is always a GST. There's always a GST. When you purchase, government already has imposed a tax. Okay? Done. Let me go to the next concept here. Tax avoidance. Very important. We'll discuss a lot of current affairs ideas here. Let's start. What do you mean by tax avoidance here? Let me start with the definition first. Tax avoidance is where the burden means amount of taxes paid. So the burden of tax or the payment of tax has become lower because of actions taken by the taxpayer. Follow the definition carefully. Follow the definition carefully. Tax avoidance means what? The amount of taxes I will pay to the government because of my actions has come down. Any difficulty? Because I've done something. As a result of that, right, the tax burden has come down. And whatever I've done, whatever actions I've taken, these are not illegal. These are not illegal. Because there are certain loopholes in the system, I'm going to use the loopholes. I'll give you examples, have patience with it. So let me define it again. What is a tax avoidance? The tax burden of a taxpayer because of their actions will go down. And whatever actions have been taken by the taxpayer, these are not illegal. None of them are illegal. In contravention to this, in contrast to this, there is one more concept, tax evasion. In contrast to this, there is one more term called as tax evasion. What is the tax evasion? Tax evasion refers to certain actions of the taxpayer where the tax burden will come down, but whatever actions are taken, these are illegal. Is it okay? Right? Understand the difference between tax avoidance and tax evasion. Both are not one and the same. In tax avoidance, there is a loophole in the system. You are going to use or abuse the loophole. You are going to exploit the system. Whereas in case of tax evasion, you are taking certain actions which are illegal in nature and you are reducing the tax payment. Let me give you a very simple example. Let me start with tax evasion. Imagine your income is 10 crore rupees. Your taxable income is 10 crore rupees. Now, rather than reporting 10 crore rupees to the government, what if you simply report 5 lakh rupees as your income? Let me know. Right? Let me know. Your income is actually 10 crore. You're supposed to pay taxes on 10 crore rupees to the government. You will not report to the government 10 crore rupees. You will simply report 5 lakh rupee as your income and pay taxes to the government. Is it illegal? Yes. Are you supposed to do this? No, you are not supposed to do this. Right? As a result of this, what you have done, you have generated a lot of black money. I'll give you one more example. Imagine you are involved in drug sales. A drug, let's say ganja. Again, don't type, sir, what is ganja? What is the color of the ganja? What are the benefits of ganja? Not required. Focus on the idea here. Right? Let's say you have you are involved in sales of the drug and you have generated a lot of income. Will you report it to government? Will you go to the income tax office tomorrow morning and say, sir, last year I earned 5 crore rupees, and the tax officer will ask you, sir, how did you earn? Right? And you will say, right, I brought ganja, I sold it to college students, and as a result, I became a crorepati. They'll say, thank you, sir. Thank you for coming forward. Thank you for your service. Come, sit inside. We'll call the police first. So have a look at this. Whenever you have generated income, either through legal sources or illegal sources, you do not report it to the tax authority. That is basically a tax evasion. Right? That is basically a tax evasion. Right? Any difficulty in understanding tax evasion? And ultimately, out of tax evasion, one of the outcomes is what? Amount of tax you will pay to the government will be lower. But this is illegal. You're not supposed to do this. Now let me come to tax avoidance. I'll show you a picture. Follow the explanation carefully. Follow the explanation. Now focus on this. I've given you two examples. Example 1 and example 2. In example 1, right, here is a country 1, country 2. Tax rate in country 2 is 10%. Tax rate in country 1 is 30%. Right, 30%. Imagine here is a company. The company A will manufacture a bottle, 1,000 rupees. They will take the bottle, export it, sell it in second country, let's say at 5,000 rupees. Let's say at 5,000 rupees. Now, how much is the profit? Simple. How much is the profit? 4,000 rupees. And let's say hypothetically, this is the structure. Let's say hypothetically, they are supposed to pay the tax on this profit in country 1. Right? So, on the profit of 4,000, how much tax will the company pay? How much is the tax will the company pay on the profit? 30% of 4,000 will be 1,200 rupees. Any difficulty, please do let me know now. Right, 1,200 rupees. But let me ask you a very simple question here. Let me ask you a very simple question. Look at the tax rate. In country 1, the tax rate is 30%. In country 2, the tax rate is 10%. Right? Answer to my question now. As a owner of company, as a profit maker, you want to pay taxes at 30% or 10%? It should be very easy for you. As a owner of a company, you want to pay taxes at 30% or 10%? All of you will agree, sir, 10% seems much better. I will pay very less amount of taxes. So let me go to example 2. Let me go to example 2. Here is the same company will manufacture the same bottle at 1000 rupee. But rather than directly selling it, what they will do is, they will set up one more company in the second country. Is it allowed? Of course, yes, it is allowed. That's the reason I said there are certain problems with the taxation law. There are certain loopholes in the taxation law. Now follow this carefully. The company A could have directly sold the bottle at 4000 rupees to the customer. They will not do that. What they will do is, they will establish one more company, company B, in the second country. Now company A will manufacture the bottle at 1000, sell it to company B at 1200 rupees. How much is the profit earned by company A? How much is the profit earned? 200. Now what the company B will do is, same bottle, they will sell it at 5000 rupees to the customers in the second country. How much is the profit earned by company B? How much is the profit earned? Company B will earn a profit of 3800 rupees. Now have a look at what is the tax on this. Please have a look at how much taxes the company will pay. The company A will pay 30% of 200. 30% of 200, how much? 60 rupees. 30% of 200 is nothing but 60. And company B will pay 10% of 3800. That is how much? 380 rupees. Now, if both the companies A and B are owned by the same person, right? There is one more company which owns both company A and B. In the earlier case, the company A paid a total tax of 1200. Now, how much taxes they are paying? They are paying a total tax of 440 rupees. They are paying a total taxes of 440 rupees. Has the tax paid by the company come down or not? Has the tax paid by the company come down or not? The numbers are there right in front of you. Do not complicate it. Numbers are there right in front of you. Taxes paid by the company have come down. Sir, what is the advantage? Why are they doing it? Simple. They are doing it because they want to pay lesser taxes. And I'll tell you one more very important point here. Many countries, rather than having 10%, they might have 0% tax rate. 0% tax rate on the profits earned by the companies. If a country has a 0% tax rate on the profit earned by the companies, if that is the situation here, don't you think the company B will not even pay 380 rupees? Right? There is absolutely no amount of tax paid by the company B here. So that's the reason, understand this carefully. What the companies have done, what the company has done here, there is a loophole in the tax system. There is a certain issue with the taxation system, and that loophole has been used by the company. That loophole has been used by the company. Now, is it illegal? Is it illegal? Is it illegal for you to basically, right, set up one more company in another market? Absolutely no. Remember this. Is it illegal for you to set up a company in another market? Absolutely no. I'll give you examples. You've heard of company Apple? Right? The companies, very, very large companies such as Apple, Amazon, Facebook, Alphabet. Alphabet is nothing but Google, by the way. Right? Alphabet, etc. All of these are American companies. All these are nothing but American companies. But these companies will end up paying the taxes on their profits not in USA, but in other countries. I hope you understand this. I hope you understand the idea here. These companies, right, what they do is, they have started working in USA, no doubt. They started functioning from USA. But what they have done tactically, right, strategically, is that the profit which is generated right, that office is registered in a country where the tax rate is very, very low. The tax rate is very, very low. And trust me when I say this, there are many countries which are offering a tax rate of 0%. Many countries which are offering a tax rate of 7%, 8% on your profit. So if you're the owner of the company, why would you want to pay taxes at 22, taxes at 35, or even 15 when you can pay 0% tax rate? That is the precise reason. What they do is they will abuse, they will exploit the taxation law, set up the office in a country where the tax rates are negligible, 0%, and ensure that it is that office which will report profit, thereby ensuring very, very negligible amount of taxes are paid by the same company. Okay, so that is basically the idea of a tax avoidance. Any difficulty here? Any difficulty? Right, so this is how companies will abuse the law, exploit the law in order to, right, basically reduce the tax liability. It is not illegal. It is not illegal. Sir, in the first case, there is no tax in the country too. My dear, if both the countries will impose a tax, that is called as double taxation. I hope you understand. In country 1 also, they will impose a tax of 30% on 4,000. Country 2 will also impose a tax of 10% on 4,000. Can I call this as a double tax? Is the logic okay? Can I call this as a double taxation? So generally, I'll discuss this later also. Don't worry. Okay. Anyway, since you have asked, let me explain it here. So have a look at this. Have a look at this. There is something called as a double taxation avoidance agreement. Double taxation avoidance agreement. DTAA, double taxation avoidance agreement. In short, DTAA. Now, what is this double taxation avoidance agreement? Let me show the example here itself. In the example 1, the company has earned profit of how much? 4,000 rupees. Any problem with this? The company has earned profit of, right, 4,000 rupees. Now, on the profit of 4,000, if government of country 1 as well as country 2 impose the tax, same profit 4,000. If two countries or two governments will impose a tax, can I call this as a double taxation? Is it okay? Can I call this as a double taxation? And you tell me now, as a manufacturer, as an investor, as a profit maker, you will be happy with the double taxation. How many of you say, sir, double taxation is good for me? I'm the owner of a company, but it is good for me. Absolutely no. Now, as a result of this, can I say investment would be affected? All of you will agree? As a result of this, investment would be affected. Investment will be affected. Right? Trust me, investment will be affected. You may think, no, sir, it will not get affected. It will be affected. Trade would be affected. Right? Trade would also be affected. There will be a lot of uncertainty about taxation policies. Because if both the countries are imposing tax on the same profit, what in the next budget, country 2 will also increase the tax rate to 30%. Have a look at this. Right? What if country 2 in the next year also will increase the tax rate to 30%? A lot of uncertainty will be created. So in order to avoid all of this, governments across the world, for example, Government of India, will have an agreement with other governments. Government 1, Government 2. They will have the agreement, where in the agreement, they will divide the tax base. Let me know if you understand this statement now or if you don't understand it. Right? The Government 1 will have an agreement with Government 2, where they will divide the tax base and they will say, on this tax base, I will impose a tax, and Government 2 will say, on this tax base, I will impose a tax. Is it okay? Is it okay? Right? The argument is the tax base will be divided, now ensuring that the double taxation will not be a problem. This is called as double taxation avoidance agreement. Right? This is referred to as double taxation avoidance agreement. Does India have a double taxation avoidance agreement? Yes. multiple DTAs we have signed. Do not by heart, right? It's not important. Okay, so concept is relevant, not the number here. Okay, so this is how companies will basically try to avoid the taxes, and this is called as tax avoidance. This is called as a tax avoidance. Now both company A and company B are owned by the same company. So basically company or let's say company XYZ, company A and company B is owned by one more company XYZ. So company XYZ is ensuring that the amount of taxes that their companies are paying are very, very low, And please understand, it's basically to avoid taxes. It is not illegal. It is perfectly legal. Okay. There is one more term here. Please remember this. Transfer price. Okay. Right. One more term here. Transfer price. What do you mean by transfer price? Focus on this concept carefully. Company A is selling good or a service to company B. It's a statement. I'm not asking. It's a statement. Company A is selling certain good or service to company B. And when company B will purchase the good or a service, company B will pay money for it. That amount that is decided or the price that is given, it is called as a transfer price. Is it okay? Is it okay? Let me know. Company A is selling a good or a service. Company A is selling a good or a service to company B. And when company B will purchase the good or service, certain price is paid by the company B. That price is called as a transfer price. Sir, why should we understand the concept of a transfer price? Let me ask you a question here. If you try to sell something to me, will you not try to sell it at as higher price as possible? I hope you understand. When you sell something to me, you're an independent company or you're a different company, I'm a different company. You want to sell the bottle to me. Will you try to sell it at as lower prices or as higher prices as possible? You'll try to sell it at as higher prices as possible. Why? You want to earn profit. Now, can I simply say, whenever companies are not connected, connected in the sense not related, whenever the companies are not related, transfer prices are determined based on market forces. Is it okay? I'll repeat it again. Whenever companies are unrelated, not connected to each other, the transfer prices are determined by market forces. That is, you want to earn more profit, I want to reduce the price so that I will not be paying more amount to you, right? Thereby negotiating with you. Any difficulty in understanding this? Let me know. Any difficulty? But when there is a transaction between two related companies, when there is a transaction that is happening between two related companies, do you think they will be following market forces? Think of it, right? Do you think they will be following the market forces? Do you think company A is selling the company B at 1,200 because company A wants to earn more profit? No, they want to earn lesser profit. They want to reduce the profit as much as possible. That is basically the argument here. The argument is, whenever two related companies will have transfer pricing, I repeat, whenever two related companies will have transfer pricing, they are not negotiating, they are not determining the prices based on their requirement, based on the market forces. They might be involved in tax avoidance. That is the reason why tax avoidance is dangerous for countries. So give example. My dear, example is there right in front of your eyes. Right? I hope you understand. This is the irony of the situation. So give example. Have I not written the example on the board? Is it not there right in front of you? Company A is selling product to company B. I said the price that is decided is transfer price. So give example. My dear, 1,200 is a transfer price. Right? I don't understand. Why don't you focus on what is there in the board rather than continuously typing? I have a problem with you people continuously typing. Why? Because if you type, you will not listen to what I'm saying. Right? So when company A will sell the product to company B will pay the price? Yes or no? At least tell me that. Will the company B pay the amount to company A? Yes. At how much? 1,200 rupees. That is a transfer price. So when company 1 will sell the product to company 2 will pay a price. I said that price is called as a transfer price. But when the transfer price will take place between related companies, the problem is they might be doing this transfer price to avoid taxes. Is it okay? Right? The companies might be involved in the transfer pricing to avoid taxes. That is where the government is concerned. That is where there is a problem. Okay, so understand the next point now. Understand the next point. In order to address the issue of transfer pricing, which will lead to tax avoidance, Government of India has implemented so many other measures. Example 2, there is a double taxation. My dear, is there a double taxation in example 2? Right? How? You tell me. You tell me how you say there is a double taxation in the example 2. Are we imposing tax 2 times on the same profit? Where? You tell me where I have told you that on the same profit taxes are imposed twice. Observe, look at the calculation carefully before asking these kind of questions. There is no double taxation. Company A is paying a tax. Company B is paying a tax. Where is the double taxation here? Okay. So understand, this is basically the idea for tax avoidance. Now, sir, what is the benefit of double tax avoidance? Double tax avoidance agreement. My dear, I started with the problems of double taxation. And if countries will enter into double taxation avoidance agreement, don't you think all these problems will be resolved? Is it okay? Right? Don't you think these problems, which are the problems of double taxation, will be resolved? It is there right in front of you. Please keep on observing. Okay. Now, there is one more concept, BEPS. Okay. There is one more concept, right? BEPS, base erosion and profit shifting. What is this base erosion and profit shifting? Focus on this picture all over again. Focus on the picture. I will be discussing and then I'll be asking a question. So have a look at this. Have a look at this. In the example 1, country 1 will earn a tax of 1,200 rupees. In example 2, country 1 will earn a tax of 60. Country 2 will earn a tax of 380. Now, can I say that when you have moved from example 1 to example 2, okay, when you have moved from example 1 to example 2, some of the profits have got shifted from country 1 to country 2. I'll repeat it again. When you move from example 1 to example 2, can I say that some of the profits have got shifted from country 1 to country 2? Agreed or not? Please do let me know. You should understand it. Profits have got shifted. And when profits will get shifted from country 1 to country 2, the country 1's taxes will automatically go down. The tax base of country 1 will automatically go down. And when the tax base will go down, the amount of taxes earned by the country 1 will also go down. This is called as base erosion and profit shifting, BEPS. Base erosion and profit shifting. I'll repeat it again. Understand this carefully. What is base erosion and profit shifting? Companies will do certain arrangements, as a result of which profits will get shifted from one country where the tax rate is very high to another country where the tax rate is very low. And as a result of this, the tax base of country 1 will go down and the tax revenue collected by country 1 will go down. This is called as base erosion and profit shifting. Now imagine you are the Prime Minister of country 1 here. Imagine you are the Prime Minister, you have the government of country 1. Will you be happy with base erosion and profit shifting? Will you be happy with the base erosion and profit shifting? Of course no, you should never be happy. Why? What if you are a developing country? What if you are a developing country? Go back to yesterday's discussion. I told you around 50 to 60% of your revenues, total money collected, will come from taxation. Around 50 to 60% will come from taxes. But what if these companies such as Apple, Amazon, etc. will be involved in tax avoidance? The amount of tax receipts collected by you will automatically go down, and it will have a huge impact on your expenses. It will affect your expenses because you are a developing country, and please understand this, the difference, understand this, between developing country and a developed country. Developing country is more dependent on taxes. I'll repeat it. Between a developed country and a developing country, it is the developing countries such as India which is more dependent on taxation. Why? Developed countries such as USA will have many other sources to generate money. I repeat, a developed country such as USA will have many other sources to generate money. What about a developing country such as India? Very limited sources. And when you have limited sources, within that, taxation is the most important source. And when, because of the tax avoidance, that is a base erosion and profit shifting, the amount of taxes collected by the government will go down, it will automatically have an impact on its expenditure. That's the reason the problem of base erosion and profit shifting is a problem for every country. It's a problem for every country. But it is much bigger problem. It is a much bigger problem for a developing country compared to a developed country. So what we have done here, right? Follow the next point. Right? What we have done here is, there are two groups. One is a G20. All of you heard of G20? Group of 20 countries. And the second one is OECD, Organization of Economic Cooperation and Development. Okay? OECD and G20. What this OECD and G20 have done is, they have come together and they have come out with a framework. They have come out with certain guidelines. And that framework is referred to as BPS Action Plan. That framework is referred to as BPS Action Plan, Base Erosion Profit Shifting Action Plan. Right? Now, should you remember all these 15 points in the action plan? Please don't waste your time. Very, very technical in nature. You will take long time to by heart it. It's not needed for civil services. All you need to simply understand is G20 and OECD have come together. They have one framework now, which India is also implementing. USA is also implementing. Many other countries are implementing. In fact, I'll give you a latest reform under this. But this 15-pillar action plan is referred to as BPS Action Plan. And in this, 141 countries are there. 141 countries now are implementing this action plan. Now, one current affairs related to this. That is Global Minimum Corporate Tax. Global Minimum Corporate Tax. Right? That is GMCT. Now, let me explain it. Follow the explanation carefully. Imagine this is country 1 and this is country 2. Right now, corporate taxes in both the countries are 30% and let's say 28%. Right? 30% and 28%. Not much of a difference, right? Almost the same. Almost. Again, I'm not saying both are one and the same. Of course, 30 is greater, 28% is smaller. But don't you think there is no much incentive for the companies to relocate their profits? I hope you understand. When one country will impose 30%, another country will impose 28%, not much of a benefit. But what if I say country 2 will reduce it? Country 2 will reduce it to 15%. Country 2 will reduce it to 15%. Now, don't you think there is more incentive for the companies to relocate their profits from country 1 to country 2? Same thing can be said regarding country 3 also. Imagine in country 3 it was 25%. So companies will start using or abusing the tax laws, exploit the tax laws, start shifting the profit. You will observe base erosion and profit shifting. Now country 3 will look at it and say, why should I stop? Why should I basically stop? Because country 2 has reduced. What I will do is, I will reduce from 25% to let's say 10%. I will reduce my tax rate from 25% to 10%. Now tell me, what is the impact of it? Now companies will start shifting their profits from all the other countries into country 3. Now country 1 will look at it. They'll say, why should I stop? Country 1 will also reduce their tax rate to 5%. Now as a result of this, what will happen? Country 2 profits will get shifted here. Country 3 profits will get shifted here. Now, can I characterize this? What is happening here? Can I characterize this as race to the bottom? I'll repeat it. Can I characterize as to what is happening in this example as a race to the bottom? What is the meaning of race to the bottom? Every country competitively are reducing the tax rate. But what is the impact of all of this? What is the impact of all of this? Impact is one, there is a base erosion and profit shifting. There is base erosion and profit shifting. Second, companies will use loopholes. Every company will now try to use a loophole, try to shift their profits into another country. And third one, as a result of all of this, don't you think all the 3 countries now collectively will be foregoing more taxes and collecting less taxes? I'll repeat it. As a result of all of this, all the 3 countries put together now will be losing lot of taxes rather than collecting more taxes. This is the problem. This is the problem that is taking place. Right? Yesterday, for example, I told you, government of USA reduced the corporate taxes from 35% to 21%. Now there was a demand in India as well. Why are we taxing only 30%? Reduce it, because USA has reduced it. So what we also have done, one option we have given 22%. And there are many other countries which are imposing a tax rate of 12%. Many countries which are giving you 0% tax rate. It is nothing but a race to the bottom. Nobody wins here. All we are trying to ensure is nobody is winning here. Every country will end up losing a lot of tax revenues. So in order to address this, now we have introduced the concept of global minimum corporate tax. India is a signatory of this. We are yet to implement it. We have agreed, let's do this, but we are yet to implement it, because for that every country will have to first agree, make changes in their domestic laws, then implement it. Now what are the points under this? There are 2 pillars. There are basically 2 concepts under this. One, pillar 1. Second is pillar 2. Now focus, understand this carefully. Let me start with example for pillar 1. Let me start with example of pillar 1. Amazon, or let's say Facebook. Again, I know Facebook new name is Meta, but recall value Facebook is much better, right, compared to Meta. But anyways, all of you will agree Facebook will provide services in India. Let me know. Facebook will provide lot of services in India. But when it comes to payment of taxes on the profits generated by the Facebook, they are registered somewhere else, not even USA. They are registered in some other country. I'll come to that. It is called as a tax haven. There is a technical term called as a tax haven. I'll come to this. Just give me a couple of minutes. So companies such as Amazon, Apple, Facebook, Alphabet, etc. All of them will provide services in India. But when it comes to the question of paying taxes on the profits earned by them, they are not paying the taxes in India. They are paying taxes somewhere else. They are not paying the taxes in USA also, because they originated in USA. They are not paying the taxes in USA as well. They are paying in some other country which is a tax haven. Government of India will not be happy with this. Government of USA will never be happy with this. Why? The companies are using our customer base, but they are not paying taxes to us. They are able to generate profits in India, but they are not paying taxes in India. How should we allow this to continue? That's a reason under global minimum corporate tax, now a new system has been introduced. What is the proposal here? Proposal is, imagine Facebook will provide certain goods or services in India, earn profit in India. Earn profit in India. Government of India will be allowed to impose the taxes on the profit and collect it. Is it okay? I'll repeat it again. Facebook, right? Let's say Amazon, etc., all these multinational enterprises, they are using the Indian market. They are generating profit. So whatever revenue they are able to generate, on that revenue, that is the revenue generated in India, I will impose a tax and I'll collect it. Right? This is a pillar one. This is a pillar one of global minimum corporate tax. Global minimum corporate tax. Right? That's point number one. Point number two. Pillar two. Right? Idea of a pillar two. What happens in a pillar two? Before explaining pillar two, let me give you example here. Let me start with a basic idea. All of you will agree Amazon is from USA. Any disagreement? Please do let me know. It started in USA. Facebook, USA. Right? Or Meta, USA. Right? For that matter, let's say Alphabet, USA. I will call USA as a home country. I will call USA as a home country. USA is home country. But these companies, Amazon, Facebook, etc., for payment of taxation, for the payment of taxes, they are registered in some other country. Is it okay? For payment of taxation, Amazon will earn profit. But will they pay the taxes on the profit in India? No. Will they pay in USA? No. They are registered in some other country, and in that country, they are paying the taxes on the profit. Right? And let's say it is registered in a country XYZ, where the tax rate is, let's say, 5%. Let's say the tax rate is 5%. 5% is the tax rate. And you might ask me, sir, why are they registered in XYZ? Look at the tax rate, you will automatically understand. In USA, the tax rate is 21%. In XYZ, it is 5%. You want to pay 21% tax or 5% tax? There itself lies the answer. Now, argument is, look at the pillar 2. Look at the pillar 2. In pillar 2, now the home country, I repeat, now the home country can calculate what is the difference between 15% and the actual tax paid by the company Amazon where it is registered. I'll repeat it. Home country can calculate what is the difference between 15% and the actual tax paid by the Amazon company on their profits. You tell me how much is the difference? 15% and 5%. How much is the difference? 10%. Any difficulty here? 10%. Sir, what if in XYZ the tax rate is 0%? Then the difference will be how much? 15% minus 0%, 15%. Any difficulty? Can I go to the next step here? The home country will be allowed to calculate difference between 15% and the tax paid by the company where it is registered. Whatever is the difference, that tax will be imposed by the USA government on the company Amazon. Is it okay? I'll repeat it again. Understand this. Home country, now will be allowed to calculate what is the difference between 15% and the tax paid by the Amazon company where it is registered. And whatever is the difference, the home country will now be allowed to impose that tax. Amazon is paying how much taxes on the profits? Look at the picture and let me know. Amazon is paying how much taxes out of its profits? In the country XYZ, it is paying 5%. Right? Any difficulty here? It's 5%. It's a simple number, by the way. 5%. And we are supposed to take 15%. That's uniform. 15%. That's the rate which has been fixed right now. 15%. So obviously all of you will agree 15% is greater than 5%. Now calculate the difference. Difference will be how much? 10%. So the home country means where the company started functioning. That's a USA. Home country now will be allowed to impose 10% tax on the profits of Amazon and collect it. Which means irrespective of where Amazon is registered, I repeat, which means irrespective of where Amazon is registered to pay taxes, they will end up paying 15% of their profits to the government. Any difficulty, please do let me know. Irrespective of any place where it is registered to pay taxes, Amazon, Facebook, right, or let's say Flipkart, or for that matter any company, any multinational company will end up paying at least 15% in the 15% out of their profits to the government. What is the advantage of it? What is the advantage of it? Advantage is simple here. Now, what is the incentive for Amazon to be registered in XYZ? You tell me. What is the incentive for Amazon to be registered in XYZ? They don't have any incentive, because earlier, right, some of you are saying lower tax. Now understand this, understand my statement. Now, if the pillar 2 is implemented, now what is the advantage for Amazon to be registered in XYZ? Absolutely nothing. There is no advantage. The reason why Amazon went to XYZ country was because they were paying 5%. They wanted to pay very less amount of taxes. Now the argument is, doesn't matter whether you are there in XYZ or ABC or any country for that matter, doesn't matter, you will end up paying 15% of your profits to the governments. So that incentive will be, right, removed. And second point, don't you think the base erosion and profit shifting will be addressed here? Right, the base erosion and profit shifting will be addressed here. Answer is yes, base erosion and profit shifting will also be addressed here. Okay, so this is basically the pillar 2 of global minimum corporate tax. Sir, it will lead to double taxation. Yes, it will lead to. But what is your way out then? You know companies are avoiding taxes. You tell me, what is your solution? Simple. Right? You are the government where companies are set up, but they are paying taxes in some other country. Right? They are avoiding taxes. You tell me, what is your solution then? Right? Now you're basically saying, doesn't matter where you are registered, I don't care about it. I will collect certain amount of taxes from you. Right? That is the advantage of having a global minimum corporate tax. And understand this, the problem is not double taxation. That's not a problem here. The problem here is there are many countries which have an option of having 0% corporate tax. There are many countries which offer you 0% tax rate, which means you are set up in USA, you are generating profits in USA, you don't pay taxes in USA, and you pay taxes in the other country where you are registered. You are not paying any taxes there also. Is it not double tax avoidance then? I hope you understand. Is it not double tax avoidance? You are not paying in USA also, you are not paying in this country also. Why should we allow you to continue to do that? So governments have agreed to this structure, global minimum corporate tax. Two pillars. Pillar 1, part of the revenue generated now can be imposed with a taxation in a country where you have generated it. Where you have generated it. Pillar 2, right? We will simply calculate what is the difference between the taxes that you are paying and the 15%. Whatever is the difference, you will have to pay the taxes to the home country. Right? Let me ask you a question here. Let me see whether you have understood or not. Imagine a company has earned a profit of 100 crore. Imagine a company has earned a profit of 100 crore. They are registered in country XYZ and the tax rate is 1%. Now, right, imagine the home country for this company. Home country for this company is India. Now tell me, how much will Government of India impose and collect a tax from this company? Let me see. And it's a very simple number, by the way. I'm not giving very difficult calculations. The Government of India will simply calculate 15% and 1%. What is the difference? 14%. 14%. So Government of India will impose a tax of 14 crore rupees from the company and collect it. This is how Pillar 2 will be operational. Is it operational as of now? Absolutely no. Is it operational as of now? Absolutely no. This is not operational as of now. Why? I've already told you. There are multiple countries, including India, more than 100 countries which have agreed to this. Right? Everybody wants to do this. But for that, one, you need to have consensus amongst all the countries. You need to ensure whatever issues are there, these will be resolved. You need to ensure countries will implement them in respective countries. That is basically the idea here. Okay. So this is one more methodology that is being discussed now in the context of global minimum corporate tax. Okay, one question, multiple times it has been put. So tax has been imposed twice, first on 60, second at 380. My dear, please look at the picture again. 60 rupees is paid by company A, 380 rupees is paid by company B. How can you say it as a double taxation? I've addressed it, by the way. I've addressed it. Company A is paying 60, company B is paying 380. How can you call this as a double taxation? It's not double taxation. We are imposing tax on two different companies. Then also you're saying it is double taxation. How? I don't know. Okay. Done. Let me go to the next one now. Okay. Let me go to the next one. This is the idea of one more reform. Right. One more reform. Right. Which has been in discussion. It will happen. It will happen. You just need to find out when it will be implemented. Now, before that, which companies will be brought under Pillar 1 and Pillar 2? In the Pillar 1, all these MNEs, MNE means what? Multinational enterprises. Multinational enterprises. MNE, multinational enterprises, which have a revenue of more than 20 billion euros will be brought under Pillar 1. And Pillar 2, right, in these, those multinational enterprises, which will have a revenue of more than 750 million euros will be brought under this. Okay, so Pillar 1 and Pillar 2, these are, right, these are the different, these are the important points. So now it's 22% and 15% or only 15%. Can you just follow what I'm saying? We have not implemented it. Is it okay? Is it okay? We have not implemented it. So if you have not implemented it, why do you basically complicate by asking me, sir, then right now 30% is applicable or 22% is applicable? It is not yet implemented. If it is not yet implemented, right, how will you come to know? Okay, right. So let me go to the next one. Concept of minimum alternate tax. What about other 13 pillars? Don't worry. Don't worry. Like I said, there are 15 pillars. You don't have to remember all the 15 pillars. Not necessary. Okay. Let me go to the next concept. Minimum alternate tax. MAT, minimum alternate tax. Now, please understand this. Before I start, here is a very important technical point. And don't do a PhD there. This is where the students have a problem. When I say stop it, you will not stop it. What is that I'm talking about? Whenever you talk about taxation, you tell me a company will pay taxes on the profit is it okay if I say the taxation, right, the provisions related to taxation will come from Income Tax Act of 1961. Yesterday also we have discussed this. The provisions related to taxation, right, that is individual taxes, right, or let's say corporate taxes, where does the provision actually come from? They come from Income Tax Act of 1961. Point number one. Point number two, every company will prepare certain financial statements, documents. Okay, every company will prepare certain financial statements or documents. One of the document, I repeat, one of the document is called as income expenditure, income and expenditure sheet. Income and expenditure sheet. Technically it is different, don't worry. I know some of you are from commerce background. They will start correcting me now. Right? It is referred as a profit and loss account, P&L account, profit and loss account. Now in the income and expenditure sheet, what the company does? On one side, right, basically they will write down all the expenditures they have incurred. All the expenditures they have incurred. In addition to the expenditures, they will also write down how much total revenue, revenue means what? Income. How much total revenues they are able to generate. Now, whenever you, right, understand this, whenever you have a number wherein revenues is greater than the expenditure, I will call this as a book profit. I will call this as a book profit. Any difficulty, please do let me know. Right, I'll repeat it. There is one statement, one document which is prepared by every company, and that is called as income and expenditure sheet, but technically it is profit and loss account, P&L account. In that particular document, the company will provide the details of all the expenses as well as all the revenues they are able to generate. And if the company's revenues are greater than the expenditure, it is called as a book profit. It is referred as a book profit. Now, please follow this carefully. Government will not impose a tax on the book profit. They do not impose a tax on the book profit. Now, the company will be allowed to use certain deductions. The company will be allowed to use certain deductions and exemptions. Company will be allowed to use certain deductions and exemptions, and after the deductions or exemptions are done, whatever you get, after the deductions or exemptions are done, whatever you get, it is called as taxable profit. It is referred to as taxable profit. And government earlier used to impose a tax on this profit and collect it. Any difficulty in the process, please do let me know. In fact, is it not similar to what government does to all of us? Yesterday I've told you this. I hope you remember it. Is it not similar to what government does to all of us? That is, if my income is 5 lakh, government will not impose a tax on 5 lakh and collect it. No. Government will first allow certain deductions. Government will allow certain exemptions. And after you deduct, after you claim exemption, whatever is left out, it is called as a taxable income. And I said government will impose a tax on it and collect it. In fact, I told you, right, section 80C, do you remember it? Section 80C, section 24, section 80D, section 80EA, etc., etc., etc. Should you remember all of it? Please don't. Please don't. It is never required for UPSC. Maybe if you become a CA, definitely yes. So argument is simple here. First, right, the companies, not government, companies will prepare a statement, right, P&L account, profit and loss account, or else it's simple, income and expenditure sheet. They will list out how much expenses they have incurred, how much revenues they have generated. And then they will calculate, assuming revenues are greater than expenses, they will get something called as a book profit. Government will not impose a tax on a book profit, but now, right, there's a concept, I'll come to that. Government earlier did not impose a tax on a book profit. Now the companies will be allowed to deduct something and they can use certain exemptions, and whatever is left out after that, it is called as a taxable profit. Government will impose a tax on it and collect the amount of money. Any difficulty in understanding the process here? Sir, what kind of deductions are allowed? Depreciation. All of you heard of term depreciation? Depreciation, right? It's a deduction. It is allowed. Dividend, right? There is one more term called as a dividend. What is a dividend? Have a look at this. Imagine here is a company, Zomato. All of you heard of company Zomato? Right? Yes or not? You should have heard it, right? You should have heard of the name of the company. Sir, no, right? What is Zomato? I've never heard it. Right? I'll give you one more example. Then. All of you heard of Adani? Adani Enterprises? Nobody has, or I'm pretty sure there is no one who will say, sir, who is this Adani? Right? That should not be a doubt now. So what you will do is, imagine you will purchase shares of the company. Again, do not worry about the definition of share. How will I purchase, etc., etc. Do not worry. Focus on the discussion. You will purchase shares of the company Adani. Part of the profit. Have a look at this. Adani is a group of companies, has earned certain profit. Part of the profits is given to shareholders. I repeat, you have purchased shares of a company and part of the profits, right, will be distributed to you. And that part of the profit which is given to the shareholder, it is called as dividend. Any difficulty in understanding the term dividend here? A company earns profit, part of the profit is given to the shareholder. That part which is given to the shareholder, it is called as dividend. Right? So have a look at this. The company has earned a book profit. Certain deductions and exemptions will be allowed, such as a dividend, depreciation, etc. And after that, you get a taxable profit. Government used to impose and collect taxes on taxable profit. Sir, why such a circus? That's where technicality will come into picture. That's where a lot of technicalities is there. What is the technicality here? The profit and loss account in case of India are prepared as per Companies Act. Understand this. The P&L account are prepared as per Companies Act. The dividends, the deductions that are provided, exemptions that are provided, all of them are mentioned in the Companies Act. But the calculation of income tax, right? The calculation part of the income tax, the provisions are there under IT Act of 1961. So now should you do a PhD on both of these acts? No. Understand point by point here. Companies will prepare the income and expenditure statements or P&L accounts. In the P&L accounts, whatever profits they have earned, that is basically a book profit. From the book profit, certain deductions and exemptions are allowed, and after that, whatever is left out, it becomes a taxable income or taxable profit. Okay? And understand the problem here. Let me show you one example. Understand the problem here. Earlier, there were companies which used to make huge amount of book profits. And after that, they used to use a huge amount of deductions also, because deductions are allowed. I hope you understand. Deductions are allowed. So a company which is earning huge book profit will make huge deductions, and as a result of this, taxable income would become zero. Right? I hope you understand. Taxable income becomes zero. So how can they use the deductions? Imagine the company has earned profit, book profit of 200 crore. They will declare dividend of 200 crores. Is it okay? One extreme example I'm giving. I'll repeat it. Company has earned a book profit of 200 crore rupees and the company declares a dividend of 200 crore rupees. Now tell me how much is the taxable income? 0 rupees. And when the taxable income is 0 rupees, government has a 30% corporate tax rate. how much tax will be collected by the government. How much tax will be collected by the government in the form of corporate tax? A grand 0 rupees. These were referred to as zero tax companies. These were referred to as zero tax companies. These are referred to as zero tax companies. Now, some of you are commerce background, like I expected, you are trying to correct me. So, dividends are taxable. My dear, please understand how the dividend tax used to function. Dividend tax, imagine the company will give you a dividend of 10 rupees and the dividend tax is 1 rupee. The company used to withhold 1 rupee out of it and give 9 rupee to the investors. That is how the dividend tax used to function earlier. We have basically removed that also. Others, don't worry. There are two people who are trying to correct me. I'm trying to tell them this is how the system used to work earlier. The dividend tax was collected by the company on behalf of the taxpayer and give it to government. That is how the dividend tax used to work earlier, right? So argument is simple here. Companies are earning book profits and right, they are claiming huge amount of deductions, which is allowed. As a result of this, corporate tax which is collected by the government is 0 rupees. These were very famously referred to as zero tax companies. Zero tax companies. Now you tell me, as the Prime Minister of this government, or let's say this country, will you be happy with these companies? Right? You are making the government. You are having the government. Will you be happy with these kind of companies? Your argument will be, they are earning book profit. They are declaring dividends to the shareholders. But when I ask them to pay taxes, they will show me 0 rupee taxable income and they will pay me 0 rupee taxes. How is that possible? We should not allow them to continue. We should not allow this situation to continue. In fact, if you're a movie buff, if you're someone who watches a lot of movies, there is one very famous movie, right? Guru. How many have heard of this? Guru. Not the Telugu Guru, right? That is not the right Venkatesh's Guru. I'm talking about Abhishek Bachchan's Guru, right? Is it required for UPSC? Here itself, I'll tell you. Is it required for UPSC? No. Right, sir, you told about Guru. Today I watched in 4 languages Guru. Right, so don't watch it. If you're not interested, don't watch it. And is it required for UPSC? Absolutely no. Absolutely no. That is not needed for UPSC. But what I'm explaining here, they have shown it. In the same movie, what I've explained here, they've actually shown it. That is, the hero will simply claim to the government he has imported machinery, so they want depreciation on it. They will claim depreciation of it. But in reality, they would have not imported any machinery. Right? So argument is simple, right? There were a lot of deductions which were allowed. Companies were allowed to use deductions. Right? So what companies did was, they used to claim lot of deductions. As a result of this, taxable income shrunk, became 0. Right? And on this, government would end up collecting 0 rupees. In order to address this, the government in 1987 introduced a new system called as minimum corporate tax. I hope you understand. Minimum corporate tax, MCT. Although it was announced in 1987, it was actually enforced. Enforced means implemented starting 1989. But over a period of time, the name has been changed. Rather than using the term minimum corporate tax, we use the term minimum alternate tax now. 1996, the name was changed. It was renamed. Now we refer to this as minimum alternate tax. And as of now, what is the minimum alternate tax? 15% is the minimum alternate tax. Now, what is the use of the minimum alternate tax? Let me show it. Let me show it. Do not by heart calculations. UPSC will not ask you these calculations. I'll take the same example. Company has earned a revenue of 1,000 crores. Expenses are 800 crores. How much is a book profit? 200 crore. Now the company will go ahead, claim deductions of 200 crore. Taxable income is 0 crore. So if I calculate a 30% tax, 30% as a tax on 0 rupee, I'll get how much? 0 rupee. Again, this is just a hypothetical calculation. Hypothetical calculation, okay? 0 rupee. But now government says, okay, right, 30% of the taxable income is 0. I will calculate 15% of book profit. I repeat, I will calculate 15% of book profit. Right? How much is the 15% of book profit? 30 crore rupees. Is it okay? 30 crore rupees is 15% of book profit. The government will ask the company to pay the tax of 30 crore rupees. Any difficulty? Let me know. Sir, corporate tax rate is not 30 but 22%. My dear, I've told you this. If you're opting for 22%, you will not be given any exemptions. I've already told this. Please follow the discussion. Please follow the discussion. So what government does is 15% of book profit and 30% of taxable profit. Whichever is greater, government will collect that in the form of taxation. Right? Sir, what if it is 100 crore? Let's assume taxable income is not 0 rupees. In fact, it is 100 crore. Don't worry about calculation. Focus on this. Don't worry about calculation. Focus. So 30% of 100 crore will be how much? 30% of 100 crore will be 30 crore rupees. But if this is 100 crore, I will have to change the book profit now. Book profit will become, deduction will become how much? 100 crore. Okay, book profits will remain 200 crore. So have a look at this. 30% of 100 crore is 30 crore. 15% of 200 crore is 30 crore. So government will still collect 30 crore rupees. So whichever is greater, simple, whichever is greater, government will collect that in the form of taxes from the companies. This is called as minimum alternate tax. Right now, the minimum alternate tax which is applicable to companies is 15%. Earlier it was 18.5, was reduced. Now it is 15%. MAT in India is 15%. Right? Can I go to the next one here? Can I go to the next one? This is one more methodology which has been introduced by the government, right? Which is basically implemented in order to address the issue of tax avoidance. Company will incur losses. How? You tell me how company will incur the losses. You show me your calculation. Then I'll tell you why you are wrong. You're simply saying company will incur loss. How company will incur loss? Right? Company will not incur the loss because, right, the machinery, etc., all of them is counted already in the form of expenditure. Okay? Okay, can I go to the next one here? Concept of GAR. Concept of GAR. Very, very important. Sir, is it 15% surcharge and cess? Yes. It is 15% plus surcharge as well as cess. Right? That is how calculation is done. Okay, next one. Concept of GAR. General anti-avoidance rules. Okay. Sir, MAT and corporate tax is tax combined or separate? My dear, did you not listen to what I said? Did you not listen to what I said? I said, if the MAT calculation gives you a higher number or the corporate tax rate gives you a higher number, whichever is the higher number, government will collect it. Right? Government will collect only one, not both of them. Then company will not have money to pay to the government. Okay. The next concept, GAR. Let me finish this. After this, we'll take break. Let me finish GAR. What is GAR here? General Anti-Avoidance Agreement. GAR is a General Anti-Avoidance Agreement. Now, what is this General Anti-Avoidance Agreement? Let me explain it to you. And let me start with a beautiful picture here. Follow the discussion carefully. In India, we have a scheme of Government of India, which is called as Special Economic Zones. Listen to what I say first. Listen to what I say. In India, Government of India has implemented a program by the name of Special Economic Zone. Now, only one point is relevant. Focus on it. Rest of the points about SEZ, I'll take up when I take up investment. Now, what is the most important point related to SEZ? You want to manufacture this bottle. If you locate the manufacturing facility in SEZ, for first 5 years, government will not collect any corporate tax from you. I'll repeat it. Only one point is needed. Focus only on one point. You want to manufacture the bottle. If you manufacture this bottle within special economic zone, government for first 5 years will give you 100% exemption. 100% exemption means what? Imagine you made a profit of 100 crore rupees. Let's say you made a profit of 100 crore rupees. Government will not collect anything from you for first 5 years. Nothing. Right? 100% exemption will be provided to you. That is point number one. Focus only on this. Don't worry about SEC now. Focus only on this. Point number two. Let's say you want to manufacture the bottle. You want to manufacture the bottle outside SEC. Outside SEC, this is called as a domestic tariff area. Is it okay? Imagine this is India. Again, I'm saying imagine. I know it doesn't look like India, but imagine. If Government of India will identify this region as a special economic zone, if government says this is special economic zone, rest of India will be referred to as domestic tariff area. Any difficulty? Rest of India will be referred to as domestic tariff area. Now, if you manufacture the same bottle in the domestic tariff area, earn a profit of 100 crore rupees, how much taxes you will pay? 30%. You'll pay 30% of this profit in the form of taxes to government. Now come to this. Arey Baba, focus on the discussion, no? I told don't worry about SEC. You people are asking questions on SEC. Don't you hear what I say? I said SEC will discuss in detail when I take up investment. Listen to what I'm discussing. And two people are typing, repeat GAR. I've not even discussed GAR. And look at the irony of the situation. I'm yet to start the discussion on GAR. I've simply given you the long form. Please repeat GAR. My dear, it simply means you are not even focused on what I'm discussing. I've not even discussed GAR. You are asking me to repeat. But anyways, okay. Right. I believe you already have typed repeat. You will simply take Control-C, Control-V. Control-C, Control-V. Focus on the discussion. It simply shows that you are not even paying attention. So focus here. Special economic zone. You manufacture, you earn profit for first 5 years, 0%, 100% tax exemption. But same bottle, if you manufacture in India, other part of India, you earn a profit of 100 crore, you will have to pay 30% of it to government. Now, simple question to all of you. Simple question. You want to pay 30% tax rate or you want to claim 100% exemption? Let me know. I hope you understand this. You want to pay the taxes at 30% or you want to claim 100% tax exemption, right? All of you will say, sir, given a choice, I want to claim 100% tax exemption. Now see here. Look at the example 2. Look at example 2 very carefully. Company B, it already has a manufacturing facility in domestic tariff area. That is, let's say, right, rather than you, let's assume I'm the person, right? Some of you will say, how dare you accuse me? Imagine I'm the person. I own a company B, which is there in the domestic tariff area, which is manufacturing the bottle. But now I'll see that in SEC, I can, right, claim 100% tax deduction or 100% tax exemption. In domestic tariff area, I'll have to pay 30% of my profits to the government. So what I'll do, just for namesake, I will open one manufacturing facility, right, in let's say special economic zone. I'll open a manufacturing facility in special economic zone. So what I will do now is, company B is also owned by me. Company A is also owned by me. Now company B will manufacture the bottle, will sell it at very low prices to company A. I hope you understand. And is it allowed? Of course, yes, it is allowed, by the way. Okay. Company B will manufacture the bottle, will sell it at lower prices to company A, which is present in the special economic zone. And this company A will export it to international market, earn a huge amount of profit. Earn a huge amount of profit. Now, two outcomes here. Because the company B, rather than directly exporting it, has sold it at lower prices to company A, don't you think companies B's profits will shrink? Companies B's profits will shrink. Point number one, it is clear. Point number two, company A is located in the special economic zone. What is the profit of company A now? Company A's profits will zoom. Company A's profits will increase. And how much taxes will the company A pay to the government? Company A will pay 0 rupee taxes to the government. Now tell me, is it not a kind of arrangement between company A and company B? I hope you understand. Is it not an arrangement between company A and company B? Some of you are saying, sir, it is a base erosion and profit shifting. My dear, base erosion profit shifting will take place across boundaries. I repeat, base erosion and profit shifting will take place across boundaries from India to, let's say, Switzerland. From India, right, let's say, to Mauritius. That is base erosion and profit shifting. Now, are we crossing the border here? Are we crossing the border? Absolutely no, we are not crossing the border. Within India itself, I have made certain arrangements in such a way that I will avoid taxes. I hope you understand. I will avoid taxes. Right? Why I will avoid taxes? That is my nature. I want to pay less taxes to government. If I ask you a choice, if I ask you people, you want to pay 1 lakh rupees or 1 rupee tax to the government, many of you will say, sir, I want to pay 0 rupees to the government. So what is the company doing here? Company is making certain arrangements. Company is making certain arrangements through which they are trying to avoid taxes. They are trying to reduce the amount of tax liability. Now, is it illegal? Right? Answer to this question as well. Is it illegal? Is it illegal that company B will manufacture the product and sell it to company A? Is it illegal? Of course no. Is it illegal that you set up company in a SEC? Of course no. Right? Of course no. But what is the problem here? The problem is you are making an arrangement in such a way that the tax liability of one company is going down and the other company, right, you are paying 0 rupee tax to government. This is one more way tax avoidance can be done. This is one more way tax avoidance can be done. Is it a problem for the government? Don't you think this is a problem for the government? Because if all the companies will start doing it, then government will basically incur a huge amount of lower revenue correction. So what government of India has done now? We have introduced a new system. We have introduced a new system which is called as GAR, General Anti-Avoidance Rules. Is it okay? General Anti-Avoidance Rules, GAR, right? The concept of GAR. What is this idea for GAR? Simple, follow this carefully. Under GAR, imagine you're a tax official. Okay? Imagine you're a tax official. Company A has submitted documents to you. Right? They have submitted documents saying that 100 crore rupee is my profit. Right? I've earned a profit of 100 crore rupees. Because government says 100% tax exemption is provided, I will pay 0 rupees to government of India. Right? You are a tax official. This document has come to you. Now you will have a look at the details of how they have generated profits. Now you will find that one of the ways they are able to generate this profit is this kind of an arrangement. I hope you understand. One of the reasons they have been able to generate a profit like this is this arrangement that they have between company A and company B. Now, will you allow this arrangement to continue? Right? In the sense, will you allow company A to claim the benefit of 0% tax with this arrangement? Answer should be no, by the way. Is it okay? Answer should be no. Right, sir? What do you mean by this? Imagine company A has generated profits only by purchasing from company B and exporting it. This is the only profit they have generated. Should you allow the company to claim a tax, 100% tax deduction here? Should you allow to do that? Absolutely no. You should not allow them to claim this tax deduction. Why? This arrangement that is done between company B and company A does not have any commercial importance. I hope you understand my statement here. I'll repeat it. This company A and company B have entered into arrangement. Is it having any commercial importance? Right? Is there any commercial requirement of this? Absolutely no. The only reason they have entered into this arrangement is to avoid taxes. It is to avoid taxes. Now understand the next point here. Such arrangements which are done are referred to as impermissible avoidance agreement. You will ask me, sir, give me example of impermissible avoidance agreement. There is there right in front of your eyes. This is an impermissible avoidance agreement. That is, the company A, company B have entered into an agreement. What is the agreement? B is selling goods to A. B is selling goods to A. That is an agreement. And as a result of this, company A, right, is avoiding lot of taxes to the government. This is called as impermissible avoidance agreement. And whatever advantage you have, whatever tax benefit you are going to get, that tax benefit will be denied to you now. The tax authority will not allow you to claim 100% tax deduction. They will not allow you to claim it. Why? You have basically avoided taxes. Whatever taxes you have avoided, the tax official will calculate and collect it from you. This is basically the application of GAR. Any difficulty here? Any difficulty? Please do let me know. Any difficulty in understanding how companies can avoid taxes? What will the tax official do? What is this idea of a GAR? Right? Now, when you say repeat, tell me from where. Should I start from taxation? I hope you understand. When you say repeat, from where? Sir, example 1, example 2, right? That should be very clear to you people. So example 2, what is the idea of example 2? I'll repeat it, understand. So repeat from introduction. Okay, let me start from introduction. Or let me start with, right, let's say syllabus. So example 2, follow this carefully. I am a company. I have a bottle manufacturing in the rest of India, domestic tariff area. I will sell it. I will export it to international market. I will make profits. Simple. I'll export it to international market. I'll make profits. But on the profits, how much taxes I'll have to pay now? 30% taxes. So what I will do is, rather than this, what I will do is, I will set up one more company in the special economic zone. And this bottle which is manufactured by company B now will be sold, right? Imagine when I export it, imagine I will export it at 200. Right? Actual cost is 100 rupee. I will export it at 200. So how much will be the profit here? 100 rupees. So rather than directly selling it to international market, rather than exporting it, I will simply sell it to one more company A at 110 rupees. At 110 rupees. Now tell me, will the profits of company B come down or not? Simple question. Will the profits of the company B come down or not? And when the profits are very low, let me pay 30% on it. Right? Even the taxes paid to the government will be very low. Now company A has taken this bottle, right? Imagine have added certain value, etc., etc. They will export it to the international market at 200 rupees. So they purchased at 110, they sold it to the international market at 200, 90 rupee profit. And how much taxes will company A pay to the government? 0 rupees. So there is an arrangement between company A and company B. There is an arrangement. But what is the use of this arrangement? Is there any commercial requirement of this arrangement? Commercially, was it required? Absolutely no. The arrangement has been done in order to avoid taxes. This arrangement between two companies A and B has been done in order to avoid taxes. So as a tax official, now you will not allow the company A to enjoy the tax benefit. You'll simply say, no, I will not allow you to enjoy 0%. I will impose 30% and collect it from you. Why? You are involved in impermissible avoidance agreement. And what is the definition? Have a look at this. It is an arrangement between two parties or two companies which has been done in order to avoid taxes and does not have any commercial requirement. It doesn't have any commercial need. Right? They are not doing it just to promote business, etc., etc. Absolutely no. They are doing it only to avoid taxes. This concept is called as GAR. Now come to this. Companies enter into various arrangements which lack any commercial substance, rather are entered only to avoid taxes. So Government of India now has introduced a set of provisions or guidelines. Okay, set of provisions or guidelines wherein the tax officials can check these arrangements, and if they find that there is a tax avoidance because of this arrangement, so they will classify this as impermissible avoidance agreement, and whatever tax benefit is enjoyed by the company, that will not be provided. The tax benefit will be withdrawn. Tax benefit will be withdrawn. Okay. So under this, the tax authorities are empowered to deny any tax benefit to a transaction arrangement between the parties which do not have any commercial benefit. GAR provisions have been introduced by amending Income Tax Act of 1961, and initially the idea was GAR would be implemented under Direct Taxes Code. Earlier government, that is when Mr. Manmohan Singh was the Prime Minister, the government had decided to restructure direct taxes. Now it should not be very difficult when I say direct taxes. They wanted to restructure direct taxes. So they had introduced the concept of a Direct Taxes Code of 2009. Then later government changed. Did we implement Direct Taxes Code of 2009? No. We did not implement DTC 2009. Rather, we have implemented these kind of reforms over a period of time. One of them is GAR, General Anti-Avoidance Rules. Done? Can I go to the next one here? Can I go to the next one? Right, so these are the various points I wanted to discuss regarding direct taxes. After the break, let's take up indirect taxes. But before that, any questions that you people have, let me know. Even the IT companies come in SEC, I don't get that why. For example, in New Town of Kolkata, many IT companies, many software companies, many service sector, many manufacturers enter into SEC. I'll discuss what is the object of SEC later, not now. I'll discuss what is SEC later. What is BEPS? BEPS is base erosion and profit shifting, wherein from one country to another country, profits are shifted. Right? What is the reason profits are getting shifted? We want to pay lower taxes. Okay, lower taxes. Okay, right. So that is basically referred to as a base erosion and profit shifting. Sir, company A will get profit. What will company B get through this arrangement? My dear, you tell me. You tell me, rather than selling it at 200 rupees, company B will sell it at 110. Right? The profits of the company, will it not come down? Right? Again, apply basic common sense. No, I even discussed that. Right? Okay. And if you are the owner of both the companies, see how much taxes you will pay in the example 1, how much taxes you will pay in the example 2. Then automatically you will understand. Okay. Is a double tax mean tax on same commodity twice or not? Okay. Double taxation means on the same tax base. Same tax base, you will impose taxes 2 times. Not on the commodity. Tax base is important. Okay. Then according to you, I will manufacture the bottle, sell it to you. GST is applicable. You will take the bottle, sell it to, let's say, customer in the market. GST is applicable. Then according to your argument, GST is double taxation. No, it is wrong. Okay. GAR imposes any tax on these companies. Idea of a GAR is not to impose taxes. Idea of GAR is certain arrangements are done as a result of which tax avoidance happens. I hope you understand this. Tax is already there. Certain arrangements have been done as a result of which tax avoidance happens. Now tax officials will find that out and collect the amount of taxes from the companies. That is idea of a GAR. MAT and GAR under pillar of BEPS, many of these are under the BEPS only, under the 15 pillars. Okay. Okay. Sir, why tax avoidance is not illegal? My dear, you opening a manufacturing facility in special economic zone, is it illegal? Let me know. You open a manufacturing facility in, let's say, special economic zone, is it illegal? No, it is not illegal. Right? Why should it be illegal? You tell me. You want to open up one more office in Switzerland, is it illegal? No, it is not illegal. Perfectly legal. Okay, done. Right? Don't worry about special economic zones. Right? How many times did I tell you by now? How many times I told? Don't worry about special economic zone. I'll take it up later, but even then, define special economic zone. Right? It doesn't make any sense. Absolutely no sense whatsoever. Okay, let's take a break. I'll start at 8:10. I'll start at 8:10. Take a break now. Okay, welcome back. Am I audible? Am I audible? Let's start. So next concept I want to discuss is the indirect taxes, idea of goods and services tax. This is the most important one. Under indirect taxes, this is the most important one. And if I've been reading the newspapers, most of these indirect taxes now have been brought under the concept of GST itself. So focus on the discussion of GST. Now, before understanding the concept of GST, right, understand certain important ideas. One is called as a cascading effect. One is referred to as cascading effect. Second one is referred to as the concept of input to tax credit. Follow the examples carefully. Imagine A will manufacture a product, sell it to B. B is not the consumer. B is, let's say, a middleman. So B will purchase the product, sell it to C. Let's say C is the consumer. So focus on the calculation now. B will manufacture the product, sell it to, A will manufacture the product, sell it to B. Government will impose a tax. Everything what I'm saying is there in the slide. Focus. A will manufacture the product, let's say 100 rupee, will sell it to B. Government will impose a tax. How much? Let's say 10%. So when B will purchase the product, B will pay 100 plus 10 rupee tax. Now B will purchase the product, right? Add certain value. Add certain value means what? It could be a raw material, right? B will warehouse the product, which is nothing but again addition to the cost. B also wants to earn profit. So now what B will do? B will take the product, 100 rupee is the price, plus 10 rupee is the tax, plus 20 rupee is the additional expenses, profit or movement of the good, etc., etc. So B wants to sell the product at 130 rupees to the customer. Now government will again impose a tax of 10% on the product. But have a look at this. When I say 10% of tax on 130 rupees, I repeat, when I say 10% tax on 130, within 130 there is already a tax of 10 rupee. There is already a tax of 10 rupee. Can I call this as tax on a tax? Is it okay? Can I call this a 10% tax imposed by the government on 130 rupees? Can I call this as a tax on a tax? Any difficulty, please let me know. Right, 130 rupees is there. Within 130 rupees, there is already 10 rupee tax. So if government will impose a 10 rupees again on 130 rupees, this is nothing but tax imposed on an existing tax. So whenever government under the sales like this, whenever sales are done and government will impose a tax on already existing tax, this is called as a cascading effect. This is called as cascading effect. And the problem with the cascading effect is, whenever you're talking about indirect taxes, always remember this, indirect taxes ultimately will fall on the shoulders of the consumers. I'll repeat it. Indirect taxes ultimately will be paid by whom? Will be paid by consumers. For example, you will go to the market and purchase this bottle, let's say 150 rupees. Out of 150 rupees, let's say 30 rupees could be indirect tax itself. So whatever indirect taxes are there, right? Whatever indirect taxes are there, ultimately will be paid by the customer. So let me know now, if there is a cascading effect in the system, can I say the tax burden on the customers will be higher? I'll repeat the statement again. Let me know. If there is a cascading effect in the system, the tax burden on the customer in the market will be higher. The example is there right in front of you. Please have a look at it. In the first step, how much tax is collected? 10 rupee. In the second step, how much tax is collected? 13 rupee. So in this example, what is the tax burden on the customer? The tax burden on the customer is 23 rupees. That's a very high tax burden. So anyways, indirect taxes will have to be paid by the customers. But if there is a cascading effect in the system, if there's a cascading effect in the system, the tax burden on the customer would be very, very high. Point number one. Point number two, earlier, understand the evolution here. Earlier, central government used to impose a tax on production which was called as excise. Earlier, central government used to impose a tax on the production called as excise. And the state government used to impose a tax on the sales of the product. On the sales of the product. Now, please be very careful where excise is applicable, where sales is applicable. Do not be confused. Sales tax would be applicable on finished goods. I repeat, sales tax would be applicable on the finished goods. For example, let me check now. Let me check. Imagine you're a shopkeeper. You will sell the bottle to the customer. Is the excise applicable or is the sales tax applicable? I hope you understand this. It should not be very difficult. Is the sales tax applicable or excise is applicable? It is sales tax. Let me take one more example here. You are a manufacturer of the bottle. I will sell plastic to you. You are a manufacturer. I will sell plastic to you. You tell me excise or sales. Don't be fooled by the term sell. I said I will sell plastic to you, right? You will say, sir, you told sales. I will apply the sales tax. Absolutely no. Excise duty. Why? Plastic, I'm selling it to you not for the purposes of consumption, for the purposes of production. So remember the logic here. Logic is simple. Whenever the goods were sold in the market for production purposes, central government would impose excise. And whenever they were sold for consumption purposes, right, the state government would impose sales tax. Right, that is point number two. Let me go to point number three. Whenever these two different tax systems were there, one by the center, one by the state, it would lead to cascading effect. Have a look at this. It would simply lead to cascading effect. Right? For example, I'll take a very simple example now. Imagine I'm selling plastic to you. I will sell the plastic. You will pay 10 rupee tax. I will take the 10 rupee, give it to government. Is it okay? Indirect taxes will have to be given to government. Right? So I will sell the plastic to you. I will collect a 10 rupee tax. Right? Let's say you have paid 100 rupee for plastic, 10 rupee for tax. That 100 rupee I will keep. 10 rupee I will give to government. Now you will take the plastic, manufacture the bottle, and let's say sell it to a customer. Let's say sell it to a customer. So when you sell it to customer, you will decide 100 rupee is the cost of raw material. Right? 20 rupee is your expenses, labor cost, right? Or let's say capital, or let's say profit. That's your profit, right? So 100 plus 20, 120. But what about the 10 rupee tax? What about the 10 rupee that you have paid? Right? You will include even the 10 rupee now because you have paid it. But ultimately, who has to bear the burden of indirect taxes? Who has to pay the indirect taxes? Customers have to pay. I'll repeat it. Customers have to pay. Do not have any doubt here. You should be very clear. Indirect taxes, customers will pay. In fact, when I was discussing national income aggregates, I told you this. That is, any indirect taxes the manufacturer pays, they will simply transfer the burden to customer. Because if you pay indirect taxes to manufacture the bottle, you are not using the bottle. Customer is using the bottle. So customer has to bear the burden of indirect taxes. So what you will do? 100 is raw material. 20 rupee your profit, labor cost, etc. You will also include 10 rupee tax because you have paid it. Now, when you want to sell it to customer, you will simply count it as 130 rupees. And now the state government would simply impose, let's say, 10% sales tax on 130. Now, don't you think out of 130, there is already 10 rupee tax? Is it okay? Out of 130, there is already 10 rupee tax. So if the state government would impose a tax on 130, that is nothing but cascading effect. As a result of this, burden of indirect taxes on the customers would be very, very high. And second problem, think of this. Think of this. If there's a cascading effect, you tell me, will the competitiveness of your product increase or decrease? Let me know. Right? I'll repeat it. If there is a cascading effect, right? If there's a cascading effect is there, will the competitiveness of your product, or you Baba, two of you are saying increases. How these products will become competitive? The price of this bottle is 143 because of cascading effect. You mean it will be cheaper in the international market? Will competitiveness of the product increase? No, my dear. Where are you looking at? Competitiveness will come down. Competitiveness will come down. So cascading effect has a problem. Simple. There's a problem. Okay. Now, what did we do then? What did we do? The state governments introduced the concept of VAT. Right? Understand this carefully. At the state level, right, they introduced the concept of VAT, value added taxation. How the value added taxation would work, let me explain it. I'll write the long form here. Value added taxes. Now, what would happen under the value added tax? Have a look at this. A will sell a product to B. Let's say A will sell a product to B. Same number, 100 rupee, 10% tax. So B would pay how much tax to A? B would pay how much tax? 10 rupee tax to A in addition to 100 rupee for product. And A will simply take this 10 rupee, give it to government. Government will receive the 10 rupee tax. Now have a look at this. Have a look at the next point. B will transport the good. B want to earn a profit of 20 rupees, etc., etc. B wants to sell it at 130 rupees. B wants to sell it at 130. But what government says is, follow the next point carefully. Follow the discussion. What government tells B is, whatever taxes you have paid on the inputs, I repeat, whatever taxes you paid on the input, I will return it to you. I hope you understand. Whatever taxes you paid on the input, I will return it to you. Meaning what? B, when purchasing the product, has paid a tax of 10 rupee, government will return the 10 rupee to B. Government will give that 10 rupee to B. Now imagine you are your seller B here. Think of it. Just think of it. You are the seller B. You want to sell the product. 100 rupees the cost of 100 rupees the cost of the product. 10 rupee taxes you have paid. 20 rupees your profit. So you wanted to sell it at 130 rupees. But government is telling you, whatever tax you have paid, I will return it to you. I will give it back to you. Will you include the 10 rupee when you will sell the product? Let me know. Will you include the 10 rupee when you will sell the product? If you include, you are wrong. Right? Some of you are saying, yes sir, I will include. Why? Tell me why. Because you are not following the discussion. What is the discussion happening? I said step 1, you will pay 10 rupee. Step 2, you will get the 10 rupee from the government. Then why will you include it? What is your argument? So what you will do? You will not include the 10 rupee. You will sell the product at 120 rupees. You will sell the product at 120. Government will impose a tax on this 10% of 120. Okay, 10% of 120, the tax will be imposed and collected. Now, simple question to you. Look at the sequence and tell me, is there any tax on tax? Let me know. Right? Look at the sequence. A will sell it to B. B will sell it to C. Is there any tax on tax that is happening here? Is there any tax on tax? Absolutely no. I hope you understand. Absolutely no. The tax on tax is not going to be imposed here. That is basically the beauty of value added tax. And have a look at this. Right? Have a look at this. when government will provide you this 10 rupee back, whatever taxes you have paid on the input, when it is returned to you, when it is given back to you, this is called as input tax credit. I have written the definition at the bottom. Please have a look at it. Right, the process where government will collect the tax, right, and return it back to you, right, credit it back to you, that is called as input tax credit. Now, is it okay if I say, if there is an input tax credit system, I repeat, if there is input tax credit system, cascading effect will be addressed. Are Baba, focus on the discussion, no? How they will give it, why they will give it. Wait, have patience. Focus on the discussion first. Right? If there is an input tax credit system, okay, will it address the issue of cascading effect? Right? Answer is yes. Answer is yes. And remember this, the idea of an input tax credit is a feature of VAT system, and VAT has been subsumed under GST. Can I say it is a feature of the GST now? Right? Is it okay? Under the concept of VAT system, value added taxation, the states, I repeat, it was introduced by the states, wherein the state government said, whatever taxes you paid on the inputs, I will return it back. I will give it back to you. And further, what you do is, you will not count it as a part of the selling price. So cascading effect would be addressed. That is basically input tax credit system. So we introduced the concept of VAT. We expected cascading effect would be addressed. But there is a problem with this. There is a problem with this. What is the problem? I said VAT was introduced by the state government. Have a look at this. I said VAT was introduced by the state government. So whatever taxes you pay to the state government when you purchase a product, that would be returned to you. What about central government taxes? Have a look at this. I'll come back to this, don't worry. What about central government taxes? Right, central government taxes will still be there. So have a look at the next situation here. Have a look at the next situation. Follow this carefully. Right, this is the state 1. This is state 2. Is it okay with all of you? First part, this part is a transaction that is happening in state 1. The other part, I'll change the color. I'll change the color of the marker. This is in the second state. So transactions are not happening in only one state. These are happening in 2 states. Point number 1, answer it now. Because polity is over for you, answer it. Whenever there is interstate trade and commerce, I repeat, whenever there is interstate trade and commerce, you tell me, will the taxes be imposed by the state government or the central government? Right? Is it okay? Is my statement okay with all of you? Whenever there is interstate means from one state to another state, trade and commerce takes place. Is it the state government which will impose a tax or the central government? Right answer is central government. Remember this, you should not have a confusion here. It is the central government which will impose the taxes. So earlier, I repeat, earlier, even when the VAT was introduced, the interstate trade and commerce came under the purview of central government. Right? You should not say, sir, why VAT is not imposed on interstate trade and commerce? My dear, interstate trade and commerce, the power, or that under the concept of Schedule 7, the power is given to central government. And even if you argue and say that no sir, it should be given to the state, let's say a product is manufactured in the state 1, sold in the state 2, you tell me which state government will impose a tax on it. I hope you understand the difficulty here. If your argument is, sir, state should impose a tax on interstate trade and commerce, right? The product is manufactured, let's say this product is manufactured in state 1 and now consumed in the state 2. Which state will impose a tax? Don't you think there will be a lot of dispute between the states? State 2 will say, consumption has happened in my state, I will impose a tax. State 1 will say, production has happened in my state, I will impose a tax. So there will be a dispute. That's the reason. Remember this carefully. Remember this carefully. Whenever you talk about interstate trade and commerce, the taxes are imposed by the central government. Point 1. Earlier, what was the system? Earlier, central government on interstate trade and commerce had a type of a tax, and that tax was referred to as central sales tax. I repeat, earlier, central government, whenever the tax was imposed on interstate trade and commerce, right, we had a concept of central sales tax. Point number 1. And point number 2, the central sales tax was announced by the center, but it was actually implemented and collected by the state where production happened. Understand all these points. Slightly technical, but understand it. I repeat, earlier the interstate trade and commerce, the tax was imposed by the center, right? The center announced it, but the tax was administered. Administered means, right, basically, right, apply it and collect the tax, and the amount would go to the state where production happened, because central government said, sir, why they gave it to the state? Because the central government said, I want to promote production in the state 1. Because the manufacturing is happening in the state 1, I will give it to the state 1. Now follow the explanation carefully. Focus on the explanation. Imagine you are there in the second state. So you are registered with the government of state 2. And I am supplying a product. I am there in the first state, which means I am registered with whom? State government 1. Now I will manufacture this bottle. I will export it from my state to your state. Simple. I have manufactured the bottle. It could be a bottle, it could be, let's say, raw material. Don't worry, focus. I have manufactured the bottle. I will move the bottle from state 1 to state 2. Interstate trade and commerce. Who will apply the tax on it? Central government. How much? Let's say 10%. 100 rupee, that is the price at which I am selling to you. CST of 10% is applicable, which means a 10 rupee will be collected on the bottle. Now who will get this 10 rupee? Think of it. Whatever we have discussed as of now, think of it. Who will get this 10 rupee? It is the state government 1. After talking about all of this, so central government will get it. My dear, what are you listening to? I don't know. Early morning you are already slept off or what? This 10 rupee will go to state government 1. Right? State government 1. So you have purchased the bottle. 100 rupee plus 10 rupee you have given. And that 10 rupee has gone to whom? State government 1. Now you have transported it. You have used labor. You want to earn profit. You want to sell it at 100 rupee plus 20 rupee profit. Now the question of 10 rupee is important. That is, you have paid a tax of 10 rupee. All of you will agree? You have paid a tax of 10 rupee. Central sales tax. Who is going to give it to you? Right? You want the 10 rupee back. You want the 10 rupee to be given to you. Now look at the problem. Central government will not give it to you. Central government will not give it because center has not collected it. You are registered with the state 2. You are registered in the second state. Do you think second state government will give it to you? Think of it. Right? You are registered in the second state. Do you think the second state government will give it to you? No. They'll say, you are registered but have not collected it. You have given it and the state 1 has collected it. Do you think state 1 government will give it to you? No, because you are not registered in the state 1. Can you find a problem in all of this? I understand. Do you see a problem in all of this? Center says, I did not collect it, my dear, so how can I give it? State 1 says, I have collected it, but you are registered in another state. Why should I give it? State 2 says, you are registered in my state, but I have not collected it. So finally, neither the center nor the state 1 and 2 will give it to you. Now what will you do? Right? Nobody will give it to you. What will you do it now? What you will do is basically you will count 100 rupee cost of the bottle, 20 rupee profit, 10 rupee tax. Now you will sell it to the customer at 130. Simple. You will sell it to the customer at 130. Now state government too is also sitting. They will say, I will impose a VAT of 10%. I will impose a VAT of 10%. So 10% on 130, now with the price of the product will become 143. Can you see a cascading effect here? Have a look at this. Can you see a cascading effect in the system? So argument is yes. Argument is yes. So understand, I'll tell you the whole process all over again. Follow the discussion, follow the summation now. Initially, central government had excise and the state had sales. Then we realized that it is causing a lot of cascading effect. So what the state governments did was, they replaced this sales tax and introduced the concept of value added taxation. Under the value added taxation, we expected that cascading effect will be eliminated, will be removed. But when you talk about VAT, VAT is a state subject. Is it okay? VAT is basically a state subject. So if you pay the taxes to the state government, government will return it to you. So the cascading effect will come down. But what about the taxes imposed by the central government? They were not covered under VAT. Simple, they were not covered under VAT. So as a result of this, cascading effect continued to happen. And as a result of this, cascading effect continued to happen. And by the way, I hope you understand this. In India, a lot of interstate trade and commerce takes place. Is it okay? In India, lot of interstate trade and commerce takes place on day-to-day basis. Thousands of crores of worth of rupees of interstate trade and commerce takes place. So despite introducing the VAT system, there was still a cascading effect in the market. Now what did we do? We introduced the concept of GST. We introduced the concept of the idea of goods and services tax. The concept of GST. Now, why did we introduce it? Right? Why did we bring in the idea of a GST? One, lot of interstate trade and commerce takes place in India, but the problem is there is a cascading effect. There's a lot of cascading effect that is happening because of these types of taxes. Second, there are a lot of indirect taxes in India. Have a look at this. Central government had multiple indirect taxes. Central government itself had multiple indirect taxes. State government also had multiple indirect taxes. Now this was much more complicated. Why much more complicated? From state 1 to the state 2, the rate of taxation did not remain same. Understand this. One complication was what? Central government had multiple indirect taxes. States also had multiple indirect taxes. But imagine this bottle is sold in, let's say, Uttar Pradesh. The government of Uttar Pradesh earlier had a tax rate of, let's say, 18%. Maharashtra would have a tax rate of 15%. Karnataka would have a tax rate of 12%. Right? Bihar would have a tax rate of 20%, etc., etc. Don't you think this is a very, very complicated structure? I hope you understand. Right? This is a very, very complicated structure. So one problem, multiple indirect taxes of the center and the state, and within the state itself, from one state to another state, different rates of taxes were applicable. Very, very complicated structure. Third one, we wanted to bring in more and more goods as well as services under the taxation to widen tax base. Is the statement okay? Right? We wanted to bring more and more goods and services under the ambit of taxation to widen the tax base. And if you widen the tax base, automatically, right, automatically the government revenues would start increasing. Okay, next one, transportation was a problem earlier. Okay, transportation was a problem earlier. Why? I'll tell you. Right, follow this carefully. Whenever you talk about transportation, imagine a product is moved from one state to another state. Understand this carefully. Imagine a product is moved from one state to another state. Earlier, at the border, right, that is between two states, there used to be a concept of check post. There used to be a concept of check post. What is the idea of a check post? The truck is passing from one state to another state. At the border, they will ask the truck to stop. They'll have to take all the documents to the government officials, show the documents. Now they'll be allowed to enter into another state. This was the idea of a check post. But Government of India conducted a survey. As per survey, have a look at this. Out of the total time taken for transportation, 1/4 of the time was actually spent at the check post itself. Is it okay? Again, this is the data given by the government. I have not made up the data, given by the government itself. 1/4 of the time that is taken for the transportation purposes, it is spent at the check post itself. Now, I hope you remember this, and I've discussed this. Let me know. If the time taken for transportation goes up, what will happen to cost of logistics? I'll repeat it. If the time taken for transportation will go up, what will happen to the cost of logistics? Cost of logistics automatically will go up. If the cost of logistics will go up, what will happen to market prices of the product? Market prices of the product automatically goes up. So don't you think the stoppage at the check post is a problem for us? A stoppage at the check post is a very big problem. In fact, I'll give you one more data point here. Have a look at this. As per Government of India's calculation, the trucks in India, on an average, travel somewhere around 290 kilometers per day. The trucks in India, on an average, travel somewhere around 290 kilometers per day. Whereas the trucks in, let's say, other developed countries such as USA, Germany, etc., they travel somewhere around 600 kilometers per day. They're able to travel or move the goods to the extent of how much distance? Around 600 kilometers. Are we not lagging behind? Are we not far behind in case of transportation, in terms of logistics? That's the reason what Government of India says now. Follow this next point. What Government of India says now, under GST, we will not be stopping at the check post. Simple. Under the GST system, under the goods and services taxation, we are not going to ask the trucks to stop at the check post. They can simply move from one state to another state, right, and to another state like this. As a result of this, the transportation logistics sector is going to get the benefit. Is it okay? As a result of this, the logistics sector is expected to benefit, right, under the concept of GST. Right, done. And finally, if you're going to do all of this, if you're going to reform indirect taxes, if you're going to bring down the number of indirect taxes, if you are not asking the trucks to stop at the check post, etc., etc., don't you think it will become much more easier to conduct business in India? It will become much easier to conduct business in India. So one of the outcomes of GST is what? It will make it easier to conduct business in India. Done. So these are certain very important reasons why we have introduced the concept of goods and services tax. Now, what are the features? Let's go one by one. Right. One of the features, what are the important features of GST? First one, under GST, we are going to streamline or subsume the indirect taxes in India. Right? Are we not stopping to check smuggling? Please understand this. If there is a valid reason, If there is a tip, etc., at any point of the transportation level, you are allowed to stop. I hope you understand this. So this will promote smuggling? No, absolutely no. Right? If you think that there's a smuggling going to happen, at any point of a transportation, you can go have a check of the vehicle. But earlier, this is a reality. Do not write it in the exam. Earlier, what used to happen is, the officials who are sitting at the checkpost, they would harass the transportation. That is basically who are basically transporting these goods. They would harass them a lot. That led to a lot of corruption in the system. And that also delayed transportation of the important goods across the state borders. So government says that we'll stop it. We'll put a rest to that. Let's stop the practice of asking the trucks to stop at the checkpost. We will eliminate the checkpost. But now you'll say, sir, what if smuggling is going on? Earlier also there were powers to the officials to stop a vehicle, not at checkpost, apart from checkpost also. Right? Those powers are continuing. It's not that we are not going to check. It's just that at the checkpost, now that has been eliminated. Okay. Now, what are the features of GST? Right? What are the important features of GST? First, we will streamline or subsume all the indirect taxes. But again, please understand this carefully. Next point is also important. As of now, even though we have a GST, there are many other indirect taxes which are out of GST. Is it okay? I'll repeat the statement. Objective of GST is what? Multiple indirect taxes are there. We'll bring all of them only under GST. Only one indirect tax. But do we or have we achieved it? Absolutely no. Right? Absolutely no. We are yet to achieve it. For example, there is I'm connecting it to current affairs. Understand it. There is a tax on alcohol products. There is a tax on alcohol products. Alcohol consumption for human attracts a tax. Tell me who imposes a tax on it. Let me check how much you are reading the newspapers. Let me check how much newspapers you are reading. It is the state government which will impose a tax on human consumption of alcoholic products. So even today, that tax on alcoholic products, it is not there under GST. So argument is simple. We want to streamline all the indirect taxes. We want to ensure only one indirect tax is there. But we are yet to achieve it. The ultimate objective is one nation, one indirect tax. Second, the constitutional amendment was introduced. 122nd Constitutional Amendment Bill. Now some of you are correcting me, sir, it is not 122nd, you are saying it is 101st, 101 Constitutional Amendment Act. That is Amendment Act, it is a Constitutional Amendment Bill. So 122nd Constitutional Amendment Bill was introduced. Reason was simple. Earlier state governments, I hope remember this, 7th schedule. I told you under 7th schedule, taxation powers have been given to the center as well as to the states. Now what you're doing is, you're taking these indirect taxes from the states and you're putting them under GST. Don't you think you need to change the constitution first? Is it okay? Don't you think you are supposed to amend the constitution first? That is exactly what I'm saying here. Right? So Constitutional Amendment Bill was introduced, passed, and as a result of this, we have GST law. Third point, under the Article 279A, we have set up a constitutional body that is constituted by President of India. Now, what is this constitutional authority? It is GST Council. It is the GST Council. So point number one, it is a constitutional body. Point number two, who are present in the constitutional body? Both we will have representation of the center as well as states. We'll have a representation of the center as well as the states. From the center, it is the finance minister, finance minister, union finance minister, who is the chairperson of the GST Council. But what about the states? will also have revenue ministers or finance ministers of the state government. Sir, is there a representation of the union territories? Of course, yes. All the union territories which have a legislative council. All these terms are very, very well known to you people now, because I've started after polity. So all the union territories which have legislative council will also be represented in the GST council. Now, union finance minister will be the chairperson. What is the function of the GST council? It is the GST council which will take decisions regarding GST. For example, whether this bottle should be brought under GST or not, right? Decided by the council. If it is brought under GST, what should be the rate of GST applicable? It is already having a GST rate of 28%. Should we reduce it? Should we increase it? If a product is already there under the GST, should we remove it? In simple terms, all the functions related to administration of the GST, the decisions are taken by the GST council. The decision is taken by the GST council. Now, I'll come back to this, don't worry. The quorum requirement in the GST council is at least 50% of the members. Right? The quorum requirement. What is quorum? I'm pretty sure you've learned about it. What is quorum? Quorum is how many members should be present. How many members should be present? If you want to start a deliberation or the discussion, what is the minimum strength that is required to start? So the quorum requirement is 50% of the total members. And voting power, right? Remember this. The decision of the GST council, can be through consensus, can be through consensus. What do you mean by consensus? Everybody is agreeing. Is it okay? Right? Everybody agrees. But what if, I'll take a simple example here. There is a proposal at the council. Right now the bottle is not covered under the GST. Let's bring it under GST. I hope you understand this. Right now the bottle is not covered under GST. Let's bring it under GST. So there is a discussion. Some of the states are in favor. Some of the states are opposed to it. Now, how will you decide? I hope you understand. How will you decide then? Right? In that case, voting is done. In that case, voting is conducted. And when you talk about voting in the council, 1/3 of the voting power is given to the center, and remaining 2/3 is distributed equally amongst all the other states. I'll repeat it again. I hope you understand this. Whenever you talk about voting, you require 75%. Right? Whether the bottle should attract GST or not. Right? How much should be the rate of GST? At least 75% of the votes should be in a favor. But how do you decide how much is 75%? 1/3 of the voting, that is 33%, is given to center. And I know, don't correct me. Sir, it's not 33. It is 33.333333. Right? Of course, agreed. Right? It's the random number like this. That is 0.3333. So I'll just round it off. 33% vote is given to the center. Remaining 67% is equally divided between all the states. Between all the states and union territories, it is equally divided. Which means whatever is the size of the state, whatever is the importance of the state, doesn't matter. Every state will have equal voting weightage under the GST council. Every state will have an equal voting weightage. It comes somewhere around 2.1%. Now, whenever the voting is done, you need at least 75%. You need at least 75% to get a majority. That is, let's say, 75% of the votes. Sir, how can I get 75% of the votes? Let's say center will agree. You already have 33%. And let's say another 22 states will agree. Right? Calculate it. You will have more than 75%. You will have more than 75% easily. So whenever you want to take a voting, at least 75% is required to decide in the GST Council. Next feature of GST. We follow a structure which is called as a dual GST. In case of India, we have a dual GST. What is the meaning of dual GST here? Dual GST simply means GST will have two components. Simple, do not complicate it. GST will have two components. One is central GST and the second one is state GST. I've written it. Have a look at this. One is central GST and the other one is state GST. What is the importance of this? Let's say hypothetically, the bottle will attract a GST rate of 18%. Okay? Hypothetically, bottle will attract a GST rate of 18%. This 18% is divided into two equal parts. Always two equal parts. 9% and 9%. Is it okay? This 9% is central GST and this 9% is called as state GST. Can I give you one more example? Let's take 28%. 28% divided into two equal parts. 14% and 14%. Which means this 14% is central GST. This 14% is the state GST. Any difficulty here? Because within the GST there are two components. This is called as a dual GST. This is referred to as dual GST. But there is one more idea here. Integrated GST. Do not be confused. Do not be confused. There is one more idea. Integrated GST. What is this integrated GST? Whenever the products are sold across the state borders, that is, the product will move from one state to another state, we call this as integrated GST. Right? Any difficulty? Please do let me know. Right? GST is not different. IGST is not different. Only idea is, if the product is manufactured and sold within the same state, we'll simply apply GST. And if the product is manufactured in one state, sold in another state, we'll simply apply integrated GST. Any difficulty? Right? Integrated means from one state to another state. Sir, why do we need it? Why do we need it? Simple. Right? Understand this carefully. Next point is important. Understand this carefully. GST is a destination-based tax. GST is a destination-based tax. Destination-based tax. What do you mean by destination-based tax here? The tax where consumption happens. I repeat, the tax where consumption happens, that state will get SGST component. I'll repeat it again. What is the meaning of destination-based tax? The tax where consumption happens, that state will get SGST component. For example, let's take the bottle. Let's take the bottle. Production in state 1 moves across the border to state 2. Right? Moves across the border to state 2. Consumption happens in state 2. Now, let's say hypothetically 100 rupee GST is collected. 100 rupee GST. Can I divide this equal into two parts? Any difficulty? Can I divide this equal into two parts? What is the rate? Don't worry. Divide this into two equal parts. 50 rupees and 50 rupees. First 50 anyways will go to central government. That is CGST. Second 50. Now tell me, should it go to the state government 1 or state government 2? Tell me now. Will it go to the state government 1 or state government 2? It is a destination-based tax. Hence, it will go to the state government 2. Because the consumption of the product has happened in the state 2. Hence, it is a state 2 which will get 50 rupees. Any difficulty? This is a destination-based tax. This is a basic idea of a destination-based tax. Now, that's the reason I said, if you talk about GST, understand this. If you simply say GST, what does it mean? production has happened in state 1, consumption has happened where? State 1. There is no question of another state. It is within the same state. But when you say integrated GST, production has happened in one state, consumption has happened in another state. That is the basic idea. Right? Is IGST applicable right now? Of course, yes, IGST is there right now. Along with GST, that is 2017, we introduced GST. So when we introduce GST, IGST is there. Right? IGST is very much there today. Okay. Right. As expected, two of you are asking, is it not unfair to the state 1? Is it not unfair to the state 1? Why will the state 1 agree to this, etc., etc.? My dear, you are looking at only one example. That's the reason you're jumping to conclusion. Answer to my question now. When I discuss the idea for GST here, does it mean that whatever is produced in state 1 will always be sold in state 2? Think of it. Just think of it. Apply basic common sense. You are looking at only one example and you are jumping to conclusion. Whatever is produced in state 1, does it mean that it will always be exported to another state? How? You show me an example. Don't you think a large part of it, which is produced in state 1, will be consumed in state 1 itself? Can I give you an example? State of Maharashtra. State of Maharashtra. Now, whenever you talk about GDP of states, you will realize that state of Maharashtra is one of the leading states in India. One of the very, very important states in terms of GDP. Now, you tell me, if the GDP of a state is higher, does it not also indicate that consumption of goods and services will also be higher? Let me know. Does it make sense or not? If GDP of a state is higher, does it also not indicate that consumption of goods and services is also good in the state? So whatever you have produced in Maharashtra doesn't mean you will bring it across the border, sell it in Gujarat. Absolutely no, you are wrong. Second, just like in this example, production of this bottle happened in state 1, sold and consumed in state 2. What about this marker? What about this pen? It could be manufactured in the state 2, consumed in state 1. Possible? Of course, yes. I hope you understand. It is very much possible. So argument is, sir, is it unfair? Will the state 1 agree to it? Will the state 1 incur losses? Absolutely no. Absolutely no. In fact, I'll tell you. Understand this, right? In fact, I'll tell you. As per the survey, the state of Gujarat, Maharashtra, Karnataka, Tamil Nadu, Andhra Pradesh. These are the states which are major earners of GST. Is it okay? These are the states which are major earners of GST. And these are the states which are production states also. Does it mean they are incurring losses? Absolutely no. You're basically arguing it based on one example. This is not the only example. Okay. Now, two of you are saying, but sir, you said thousands of crores of interstate trade and commerce happens. Okay. It simply means I will have to tell you everything. I'll have to spoon feed you everything. My dear, thousands of crores of interstate trade and commerce happens. It doesn't mean there is no trade and commerce within the state. Right? I don't know, how do you make your assumptions? How do you make your conclusions based on one statement that I give? I said thousands of crores of interstate trade and commerce happens. So what is your assumption? What is your conclusion? It means whatever is produced in state 1 will be sent to state 2. Whatever is produced in state 1, nothing will be consumed in state 1. Who said that? Who told you that? Did I say that? Right? Again, do not make your own conclusions. Okay. So come back to this. We have a dual GST, central GST, state GST. We also have IGST. IGST is applicable whenever states will move from one state to another state. Okay. Now, what are the slabs we are using in India? Slabs means rates. What GST rate are we using? We have 5%, we have 12%, we have 18%, we have 28%. That is, you take up any number. So 5%, is it equally divided between center and state? Yes. Sir, what about 12%? Is it equally divided between center and state? Again, the answer is yes. What about 28%? Equally divided between center and state. But what is the important point here? Whatever is the division, one part will go to the center, second part will go to the state where consumption has taken place. That is the reason I said GST is a destination based tax. Now let me ask you a very simple question. Tell me, is a central sales tax, is the central sales tax, is it a destination based tax? Think of it and answer to me. Central sales tax, is it a destination based tax? Right, two of you are saying yes. How? Right, how? I told you, in fact, I wrote it, I gave you example, etc., etc. It's not a destination based tax. Right, if you remember, this bottle was manufactured in state 1, right, was consumed in state 2. Who got the central sales tax? Which state got the CST? State 1, not state 2. Right, where are you looking? I don't know. So central sales tax is not a destination, it is origin based taxation. Origin based taxation. Origin based taxation. Let me ask you one more question. Let me see. What about VAT? Tell me now. What about VAT? Is a VAT destination based tax or origin based tax? Is VAT a destination based tax or a origin based tax? It is, right, you're basically divided. Some of you origin, some of you destination. It is a destination based tax. In case of India, this has been implemented as a destination based tax. Sir, how? How? I feel it is origin. My dear, this product is manufactured and consumed in, let's say, state 1. It's manufactured and consumed in state 1. Who will get VAT? Who will get VAT? Who is going to impose VAT in the first place? Think of it. Who is going to impose VAT? State 1. Who is going to collect the VAT? State 1. Right? So state 1, consumption, production happens in one state. Now some of you will say, sir, what if it is moved into another state? First and foremost, when the product will move to another state, VAT is not applicable. Think of it. When the product will move from this state to another state, is VAT applicable? How many of you think VAT is applicable there? Wrong. CST is applicable. Right? We have discussed all of it. It's not as if I'm introducing something new to you. Right? If the product will move from one state to another state, is VAT applicable? No, CST is applicable. Now imagine this product is sold in the second state, consumed in the second state. Now you tell me, who will impose VAT and collect it? Second state. I hope you understand. Second state. So where the state, or in whichever state the consumption happens, that state will collect the tax. Is it not destination based? Let me know, is it not destination based? So argument is yes, by the way. Yes, it is also destination based tax. VAT, GST, examples of destination based taxation in India. CST, example of origin based, production based taxation in India. Okay, right? So that is the basic idea. Now, is there anything which is not under GST as of now? Okay, is there anything that is not under GST? Example, alcoholic product for liquor consumption. Some of you are saying petrol, petrol, petrol. I'll come to that. Right? Have a look at this. Right? Exempted alcoholic liquor for human consumption. As of now, alcoholic products are yet to be even brought under GST. It is not there under GST. Now, if you want to bring alcohol under GST, again you will have to amend constitution. All of you will agree? I hope you understand this. If you want to bring alcohol under GST, you will have to amend the constitution. Why? Right now, as per Constitution of India, the right to impose a tax on alcohol for human consumption in the domestic market is given to state. Now you want to bring it under GST. Are you not supposed to amend the Constitution first? So that's the reason exempted alcoholic liquor for human consumption. What about imported alcohol? What about imported alcohol? How many of you think imported alcohol tax is imposed by the state government? Please look at the term. Please look at the term. Imported. Right? Who do you think has the right to impose a tax on imports? Right? Who do you think has the right to impose a tax on import? Center. Center. This is how UPSC will test you. Please be very, very careful. And I'm pretty sure all of you are, at least all of you have heard of the Delhi liquor policy. That is where UPSC can simply catch hold of you, confuse you here. Right? Imagine a statement is given like this. Imagine a statement is given like this. Statement is all the liquor either imported or manufactured in the domestic market, the state government as per the Constitution has the right to impose a tax. No, statement is wrong. If it is manufactured and sold in the domestic market, it is the state government. If it is imported, it is the center. Anything that is imported, simple, anything that is imported, the tax is under the central government. Okay, now exempted alcoholic liquor for human consumption. GST Council is yet to decide. This is where I want you to focus. Petrol, diesel, natural gas. Many of you are writing, sir, petrol is exempted, etc., etc. No, petrol is not exempted. Understand this carefully. We amended the Constitution and said these are the goods and services which will be brought under GST. Follow this. Follow this. Sir, your class is very boring. Thank you. Okay, focus on this. No, don't focus on the boring aspect. Focus on the important point. Okay, so understand this. We amended the Constitution and we said these are the goods and services which are brought under GST, which will be under GST. And in the list, the fuels are already present. Is it okay? In the list, the fuels are already present. So one, now if GST Council wants to announce a GST, do they need to amend the Constitution? Think of it. Right? I hope you understand the difference between alcohol and fuel products now. Right? Do you think the government now should amend the Constitution to announce a GST on fuels? Absolutely no. Absolutely no. They can announce the rate on fuels at any point of time. So understand this carefully. The fuel products are not exempted. These are not exempted. These are there under GST, but the council is yet to announce it. Why? I'll tell you in a minute. Whereas alcohol for human consumption, it is not even under GST. Forget about announcing it. You want to bring it under GST, first amend. First change, bring it under GST. Then you can decide whether the tax is applicable, how much, etc., etc., etc. Now, many of you will ask me, one, sir, why is alcohol yet to be brought? Second, why are we yet to announce a tax on fuels? Reason is simple. Large amount of taxes collected by both the center and state are on these commodities. I hope you understand. I hope you understand this. Large number of or large amount of taxes collected by both center and state are on these commodities. For example, you check how much of the total amount collected by the states is in the form of taxes on alcohol. These will be in the range of 10%, 18%, 20%. So you tell me, you are the chief minister. Now I am making you the chief minister. You are the chief minister. I will tell you, let's introduce a GST. I want to take away the tax power you have on alcohol. I want to bring it under GST. Will you give it away? I hope you understand. Will you give it away simply? You will not agree to it. You will simply say, no, 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 no. I want to cover taxation on alcohol. Why? I want to adjust it as per my requirement. I want to collect huge amount of money. What about this thing? What about petrol and diesel? Same argument. Right now, understand this. Imagine you go to a petrol bunk, you purchase 1 liter of petrol and you pay 100 rupees for it. Just a hypothetical number. Okay, have a look at this. Right, you go to a petrol bunk, you purchase 1 liter of petrol and you will pay 100 rupees. You will be surprised now because more than half of this is because of central government taxes and state government taxes. Is it okay? More than half of this, out of 100 rupee, more than 50 rupees is because of the central government as well as the state government taxes. Now you tell me, if you bring it under GST, what will be the rate? I hope you understand. If you bring it under GST, for example, if you want to understand the difficulty here, imagine 100 rupees, right, divided into two components. 50 rupees actually the cost and 50 rupees the tax of both center and state. Can I say the total tax is applicable, that is 100%? Is the logic okay? Is the logic okay? Right, you are paying 100 rupee. Imagine 50 rupees actual cost and remaining 50 is thanks to the taxes of both center and state. That is how much tax? 100% tax. Now you tell me, what is the maximum rate of tax applicable under GST? 28%. And how much is the rate applicable now? Both center and state? 100%. Don't you find there is a lot of difficulty here? Right? Based on the number itself, you will realize lot of issue here. Why? If you bring it under GST, tax rate is 28%. Right? Suddenly the revenues of the government will take a hit. And concern is that even if you collect 28%, now how much should go to the state, how much should go to the center? Because as per the law, half and half should go to the center and state. But as per the current situation, can your state government increase the tax on petrol and collect more money from you? Think of it. Right? As per the current arrangement that we have on petrol and diesel, can your state government increase the tax on petrol, collect more money? Of course, yes. Now, once it is brought under GST, can your state government do it? I hope you understand. Once it is brought in the sense, once the GST rate is announced, can only one state government increase the tax rate on petrol? Not allowed. Can they decrease the tax rate on petrol? Not allowed. Now everything has to be done with at least 75% voting. Now you tell me, again you're the chief minister, will you agree? I hope you understand. Will you agree? Right? Absolutely no. Absolutely no. Until unless you have a very, very good revenue model where you're guaranteed you're going to get certain amount of money, you will not agree to it. Is the logic okay? Why, despite fuels being brought under GST, GST rate is not applicable? Why alcohol itself is yet to be brought under GST? These are the reasons. Please be very, very careful. Okay. Now, come to the next concept, compensation. Come to the next concept, compensation. What is this idea for compensation? I'll take a very simple example. Right? Let's start. I'll take a very simple example. Imagine here is a state 1 or state A. Now this is state A, or let's say I'll write it as state 1. State 1. Now this particular state 1 is imposing taxes on 3 products, A, B and C. It is imposing a tax on 3 products, A, B and C. And as a result of the tax on all the 3 products, government of this state is able to collect, let's say, 100 crore rupees. 100 crore rupees. But now government will introduce a GST, center will introduce a GST and say that I will take product A, product B and I'll subsume both of them under GST. Okay, I'll subsume both of them under GST. Let's say earlier product A would get you 40 crore rupees, product B would get you, let's say, 30 crore rupees, and product C would get you another 30 crore rupees in the form of taxes. So when product A and B are brought under GST, it simply means now this amount of revenue which you are able to collect earlier, 40 plus 30, you are able to collect earlier. Now there is no guarantee over it. Is the logic okay? You are able to collect 40 crore rupees and 30 crore rupees earlier. Now there is no guarantee over it. Why? Because once it is brought under GST, you will not have the power to adjust the tax rate on both of them. Right? I'll repeat it. Because both the products A and B have been covered under GST, now you do not have the power to adjust the tax rate on A and B. How will you have the power? Everything is decided by the GST Council. And in the GST Council, you require at least 75% voting. Will you be worried about your revenues or not? Will you be concerned about your revenues? Will you be worried about the amount of revenues you are going to collect under GST? Of course, yes. Because until these were brought under GST, you could arrange. You could simply arrange the tax rate. In 1 year, you will increase it to 20%. In another year, you could increase it to 20.5% and adjust and collect as per your requirement the amount of revenues. But now it is under GST, you do not have the power individually. So what was decided? States were concerned, if these taxes are taken away from us, what if I do not collect sufficient revenue? That is, let's say you have collected 40 plus 30, 70 crore rupees. Now both the products are brought under GST. Rather than 70 crore, you will collect 50 crore rupees. What will happen to your revenues? You have not collected sufficient amount of money, your expenses would be affected. States were concerned. And that's the reason there was an agreement between the center and the state. An arrangement was introduced, that is for the next 5 years. I repeat, for the next 5 years. What do you mean by next 5 years? 2017, GST was introduced. So from 1st July 2017, in fact, I'm giving you the date now. From the 1st July 2017, for the next 5 years, whatever is the revenue loss, I will tell you how revenue loss will be calculated. Give me a minute. Whatever is the revenue loss, 100% of this revenue loss will be compensated by the center. Is it okay? 100% of this revenue loss will be compensated by the center. Now look at the next point here. 1st July 2017 we introduced. Calculate 5 years. Calculate 5 years. So from 1st July 2017, 5 years will be how much? End of June 2022. Is it okay? End of June 2022. Have we crossed end of June 2022? Let me know. Did we cross June of 2022? Yes. Which means the compensation period is over. Is it okay? Which simply means the states getting the compensation from the center, it is over. 5-year duration is over. States wanted the extension, but no, center has said, I will not give it. Right? So 5-year duration, 100% of the revenue loss. Now you will ask me, sir, what do you mean by revenue loss? What do you mean by the revenue loss here? Follow the next points carefully. In this example that I've written, how much revenue you used to collect? How much revenue you used to collect? 40 crore and 30 crore. So you collected 70 crore rupees last year. Is it okay? You collected 70 crore rupees last year. But can we take the same 70 crore rupees as a reference point for every year? Does it make sense? Think of it. Can we take the same 70 crore rupees as a reference point for every year? No. From 1 year to next year, don't you think the revenue collection should increase? I hope you understand. From 1 year to next year, don't you think the revenue collection should increase? That's the reason government decided, right? Look at the formula now. Last point. We'll finish the formula, then we'll stop. The government of India came out with a formula. What is the formula? Whatever taxes you collected from these, which are subsumed under GST, whatever you collected in 2015 and 2016, we will take it as a base. I'll repeat it. Whatever taxes you collected on A and B, which are subsumed under GST, in 2015 and 2016, we'll take it as a base. Sir, why 2015 and 16? From next year, we have introduced GST. So whatever you have collected in this base, right, we will take it as a reference point. And we will assume that it will keep on increasing from 1 year to the next year by 14%. It will keep on increasing from 1 year to next year by 14%. Let's say hypothetically, I'll take the same number. Let's say hypothetically, you have collected 70 crore rupees. Right? You have collected 70 crore rupees, right, in this 15 and 16. Sir, why not 16 and 17? My dear, negotiations had already finished. Right? 1st July 2017, we implemented GST. Does it mean that on the same day we decided everything? Apply common sense, no? Apply common sense. It's not that every day or let's say within half an hour you will decide everything. So for a long time there was a discussion, a decision was arrived in a previous year. So what was the previous year to that? 15 and 16. So what was the revenue in 15 and 16? Let's say 70 crore rupees. We'll simply assume that next year it will increase by 14%. And I'll throw arbitrary number, don't calculate, UPSC will not ask you calculations. Let's say 14% rise will mean, let's say, collection of 80 crore rupees. Collection of 80 crore rupees. But under the GST, you collected only, let's say, 40 crore rupees. I hope you understand. In GST, you collected how much? Only 40 crore rupees. Now, how much is the revenue loss here? How much is the revenue loss? 40 crore rupees. Revenue loss is 40 crore. Government would simply provide this 40 crore rupees as compensation to the state. Is the logic okay here? Is the logic okay? So I'll repeat it again. The states were concerned that if I give away the taxation power, I might not earn sufficient amount of revenue. So center and state came to an agreement wherein center said, once I start implementing GST, for next 5 years, I will provide 100% revenue loss, 100% of the revenue loss in the form of compensation. But how do you calculate revenue loss? How do you calculate revenue loss? Simple. We take whatever was the revenue collected from those taxes which were subsumed under the GST in 2015 and 16 as a base. And from that, we'll simply keep on adjusting that with 14%. Increase that with 14%. Right? So imagine for 1 year, you are supposed to collect 100 crore rupees as per the formula. That is the expected amount of revenue as per the formula. But if you end up collecting only 70 crore rupees, now tell me, your expected revenue as per the formula is 100 crore. You collected only 70 crore rupees. How much compensation will be paid by the center? Compensation paid by the center will be 30 crore rupees. So for 5 years, from 1st July 2017, government announced a compensation. And already June 2022 is over. Government has discontinued payment of compensation to the states. And last point here, from where will the government get this money? Okay. From where the government will get this money? If they want to pay, let's say 30 crore rupees, from where will the government get this money? For this, Government of India identified certain commodities which were covered under 28% GST. I hope you understand this. We identified certain goods which were covered under 28% GST. In addition to the GST of 28%, we also imposed a cess. In addition to the 28%, we also imposed a cess, and this is a compensation cess. Is it okay? This is referred to as compensation cess. Okay, so we used to impose cess, collect it, use it for the payment of compensation to the states. Right, so this is the discussion. We'll stop the discussion here. I'll give you certain more concepts or points related to compensation cess tomorrow. Let's pick it up from this concept itself. Right, we'll start from tomorrow, the idea of a compensation cess. So what are other additional points? Done. So let me stop the discussion here. Any question you have, please ask me now. Please repeat, how was it 122nd CAB, my dear? The bills are introduced. All the bills are not passed. I hope you understand. The bills are introduced. All the bills are not passed. So the number, right, the sequence of a number which was assigned to this bill was 122nd. And when they are passed, some of them may not be passed. So when it was passed, what was the sequence of the number which was given to the Amendment Act? That was 101. Right, so number of the bill and the amendment slightly changed. Focus. What was the benefit of VAT? VAT was introduced by the state governments to address right, the cascading effect. But despite having a VAT, I've proved, and you have seen that also, despite having a VAT system, there was a cascading effect. That's the reason we have subsumed, brought the VAT under the concept of GST now. Sir, is the states still incurring revenue loss? Right? Please understand, you cannot calculate the revenue loss now. Why? The formula is applicable only for 5 years. Formula is applicable only for 5 years. After that, there is no formula applicable. What is 28%? Right now, GST is applicable 5%, 12%, 18%, 28%. Do you think on this bottle all these rates are applicable? No. Some of the products will be covered under 5%, some under 28%. So under 28%, we have identified certain products. In addition to 28%, we are also imposing cess. That cess will be used for payment of the compensation. What about excise duty? It will still lead to cascading effect in absence of GST. Please understand. There is a concern there. We'll discuss that. Because I told you, despite introducing GST, even today there are various products which either do not have GST or are not covered under GST. Right? So we need to address that as well. Sir, if the state one produces and state one consumes, how to distribute tax? If the GST collected is 100 rupee, center will get half of it, 50. The state will get remaining half of it, 50. Central sales tax is origin based tax? Yes. CST is origin based tax. Sir, did the center provide compensation during COVID also? Yes. Center provided compensation even during COVID. Will amendment be needed to include liquor? Yes, because right now, as per the constitution, liquor is under the state. Okay, any more doubts? Any more doubts? Cess is the education and healthcare cess in the last class. No, Baba, that is a different cess. Those cesses are imposed. This cess I'm talking about, is a compensation cess. In addition to the GST of 28%, there is a compensation cess again. Currently, only item not under GST is alcohol, liquor for human consumption, electricity. Right? There are certain goods, you don't worry. Right? Remember, examples more than sufficient. What is excise duty? Excise duty is that let's say tax which is imposed by the government on production. Okay, so let me stop the discussion here now. Okay, let me stop the discussion here. Tomorrow we'll continue from the compensation cess. Couple of more points are there. I'll cover it. then I'll show you, right? Many of your concerns are which state will get how much, etc., etc. Do not have a heart attack. I'll show it tomorrow, right? But moreover, please understand, is it needed for civil services? Absolutely no. I'll show you two tables, this one and this one. And some of you look at it and already have a small heart attack, or let's say, right, a heartache already. Is it needed for civil services? Absolutely no. Because most of your concern, which is not at all needed for services. So how much state will get, which state will get, etc. I'll prove it. Don't worry. I'll prove it, but do not buy at the calculations. Done? So let me stop the discussion here. Right, we'll continue tomorrow. We'll cover some more concepts of GST. Then we'll discuss certain more aspects related to overall taxation in India. That will be the coverage for taxation. Okay, that's it from my side. See you tomorrow then. See you tomorrow morning, 6 a.m. Right, take care. Have a great day.